Okay, so welcome back. We are now moving on to learning outcome number two. So the first topic under learning outcome two is about the board of directors. So as I mentioned before, is anytime you see in the legislation is a directors, plural, then is referring to the board of directors. Or if you look at some article or your reading materials that talk about the board, um, by default, it would mean the board of directors. Okay, we would not refer to shareholders with the term board. Okay, now to the different types of directors. There are many different ways to describe or classify them. So let's start with the first one: executive and non-executive directors. So as the name suggests, executive directors are the one who are running the business, running and managing the company. That's executive directors. So it's a good chance they are the one responsible for the day-to-day management of the company. Okay. However, on the board of directors, in addition to executive directors, there are also non-executive directors. So these are the ones who would not be involved on the day-to-day running of the business, would not be the one who would basically full-time looking after the business, but they are on the board nonetheless, and that's why they're called non-executive directors. So there are different ways of looking at it, but one of the benefit of non-executive directors is they are not the one who is actually making the decision and negotiating the contract and entering into a contract. So if they are a part of the body overseeing the operation of the company, they feel it's more objective as well. So that's the first one. Okay, then move on to the second one is managing directors. So we have the board of directors and you have directors on the board, but it's possible for the company to decide to appoint one or more of the directors as managing directors. So managing directors, you would expect they are the one in control and managing the business, but there's actually a slight difference between a managing director and just a director. Generally speaking, an individual director cannot make decisions on behalf of the company. An individual director cannot sign contracts on behalf of the company. Only the board of directors can, as that organ, as one of the organs of the company. However, due to practical needs, it is possible to appoint a managing director, one or more, and that managing director individually can sign contract on behalf of the company and it will be binding on the company. So that's why it does make a difference whether that person is an individual director who's sitting on the board of directors or if that person is a managing director who would sit on the board as well, but the managing director obviously would have more power than individual directors. Okay, then moving on to the next one is de jure directors. Okay, this simply means someone who was officially appointed as a director. So you went through the process of nominating that person as a director, and that person appointment was approved. In that case, you have a de jure director, which means officially appointed. So there will be no doubt whether that person is a director of the company or not, because it's done officially, you've gone through the process, was approved, and of course it's on record. Okay, so that's de jure director. The next one is de facto director. De facto director are not officially appointed director. That's the biggest difference. So de facto directors are not de jure directors. That's one way of putting it. So what is a de facto director? It's someone who acted as a director of the company, but was not officially appointed as one. Okay, so you may wonder why is this so important? Well, I think the most obvious scenario is when an outsider is dealing with your company. They may not really know for sure who is or who is not officially appointed as a director of the company. So if someone is represented as one, appears to be one, then there must be some liability that goes with it. So that's why you have de facto director. So there will be an exam question talk about this, so I won't go into too much detail. Okay. The next one is shadow directors. Okay. Shadow directors also not officially appointed as a director of a company. Okay, you have all these directors who are officially appointed, so they sit on the board. They sit on the board of directors. Sometimes it is possible one or more of those directors are actually acting under instructions. Okay, so in that case, it's sort of like someone behind the scene pulling the strings, controlling the officially appointed directors to act in the wishes of that person behind the scene. So in that case, we would refer to that person, the entity or individual, as a shadow director. Okay, so these names are well known because they actually do come up in court cases, and the courts have dealt with these type of situations, and that's why it is important to be aware of them. De jure directors, de facto directors, and shadow directors. Okay, moving on to the next one is alternate directors. Okay, what is an alternate director? Imagine you're on a board, you're officially appointed, but let's say you are very busy and sometimes you have to fly to some other countries and you cannot attend the board meetings. In that case, you may officially appoint an alternate, someone to attend the meeting on your behalf and someone to vote on meetings on your behalf. So that's an alternate director. So these are all official. In other words, alternate directors is mentioned in the company's ordinance, and there are procedures for appointing and also removing alternate directors. Okay, moving on to the next one, nominee directors. So what does it mean by nominee directors? So nominee directors is someone officially appointed as a director of the company in name only. That's why it's called nominee director. Why do we need to do that? Well, I have to go back a little bit into history because now it may not be as necessary. So in the old days for a private company, even for a private company, the minimum number of directors for a company is 2 back then. Okay, so let's say I want to start my own business for my own startup and I'm the only person involved, so I will be the director and the shareholder. However, if the company's ordinance says I must have 2 directors as a minimum for my company, then I must appoint another person or another entity to be a director just to satisfy that requirement of the minimum of 2 directors. So in the past, that I believe was the main reason why they have nominee directors. So let's say if you have a professional firm and they set up a company for you and you are named as a director and shareholder, then maybe one of the staff or the companies will be named or appointed as a nominee director just to satisfy the requirement. Okay, nowadays no longer required. If you are a private company and you meet the requirements, basically it is permitted to have 1 director and 1 shareholder and 1 company secretary. So you can have the minimum number of people involved for your company. So in those type of situations, no need for a nominee director. Okay, then let's now move on to the next bullet point, appointment of directors. So as I mentioned before, a de jure director is someone who's officially appointed as a director of the company. So how do you go about doing that? Well, first of all, someone needs to be nominated to be a director of the company. And then the nomination or nominations, depending if you have 1 or more directors being nominated, is presented to the board of directors, and it's for them to decide whether to appoint that person as a director or not. Also, as a formal process, at the very beginning and also at the end of each year, appointment can also be by shareholders in general meeting. So you can understand is the shareholders are the owner of the company. They want directors to run the company for them on their behalf and hopefully in their interests. So that's why you would expect is the shareholders with the power to appoint directors. So that's why each year at the AGM, you say, okay, there may be a rotation basis. So these directors are now come up for reappointment. Then it is up to the shareholders to decide whether to appoint them or not. Now, during the year, sometime maybe you need to fill a casual vacancy. What does that mean? Let's say if you have 10 directors on a board and one of them resign, you may need to nominate and appoint someone else. In that case, it is possible for the board of directors to approve that nomination. Okay? Of course, when it comes to the end of that year, the same appointment needs to come up to the shareholders for them to affirm whether that person will be appointed as a director or not. So these are all the practical side. Okay, now let's take a look at resignation of a director and removal of a director. So the two, even though the outcome may be the same, are quite different. The way I would describe it is resignation of a director is voluntary. I wish to resign from my position as a director of the company. Okay, removal of director generally not voluntary. It is the directors or the shareholders wishing to remove that person as a director of the company. So let's look at resignation first. So it's a voluntary basis. So obviously you submit the resignation and then most likely it will be accepted. And in that case, after the effective date, you will no longer be a director of that company. And in some case, the company may decide to fill that casual vacancy during the year, but they do not have to. It depends on them. And if they don't want to, then at the end of the year, it's entirely possible the shareholders, if they wish, they can appoint someone else as a director. Now, for removal, since it's involuntary, it is actually done by the shareholders. And when I say shareholders, I mean shareholders in general meeting. So it's not like, I own shares in a company. Can I vote to remove a person as a director? You cannot, because only the shareholders together as a decision-making body in the general meeting can do that. So if someone is to be removed, then obviously there are formal procedures that must be followed because it's a serious decision. You have someone who is charged with the responsibility to manage and run the company on behalf of the shareholders. So you will not take the decision to remove him or her lightly. It is possible the director may have done something bad, let's say for example, and they want to remove him. Let's say he did not fulfill or breach his fiduciary duties. But it's also possible he's doing something good, meaning he discovered the other directors were doing something not in the interest of the shareholders, and those remaining directors try to remove him or her. So that's why the removal process must be very careful, and you would actually need to call a general meeting of shareholders. And in the notice, you must clearly state we're holding the meeting to remove a director, and details must be provided. You will need a information to be also copied to the directors to be removed so that the director has a chance to attend the general meeting to state his or her side of the story, and then for the shareholders to decide whether to vote yes or vote no to remove this director. So it's a very important process, and that's why you can see resignation and removal not the same, because resignation is by your own choice. You want to leave. In most cases, of course, they will let you leave. They cannot keep you there by force. But when it's removal, when it's forcefully removing you involuntarily, then of course you have the formal process a lot more important. Okay, so let's look at some sample questions from the past papers, starting with question 4 of the June 2024 paper. Let's go to this one. So this one is, who is not eligible to act as a director of a company? And then you will see that's actually very similar to the question in November 2022. So let's take a look at this one. Under statute, explain which persons are not eligible to act as a director of a company. So according to the examiner, candidates were asked to explain which persons are not eligible to act as a director. So most candidates correctly pointed out that a minor or a bankrupt is not eligible to act as a director of a company. So that's good news. So you can understand is because the directors are acting on behalf of the company, they will need to, for example, enter into a contract on behalf of the company. So that's why you must have the capacity to enter into contracts. And one of the requirements of capacity is you must be 18 years old or above for most commercial contracts. So in that case, if that person is a minor, cannot be a director of the company. Also, cannot be a bankrupt. What does that mean? So bankrupt is the term we use in Hong Kong for individual people who cannot repay their debts as they fall due. So in that case, they're saying if someone cannot properly manage their own finance, how can we entrust that same person to manage the finance of our company. So generally speaking, I think that's the underlying rationale, underlying reason. So that's why minor or bankrupt not eligible. Now, according to the examiner, only a few candidates noted that the company's statutory auditor is not eligible. So understandably, the auditor under the company's ordinance are charged with the duty to review the financial statements and the related affairs of the company and to issue an opinion on whether it is true or fair, on whether it complies with the company's ordinance and comply with the accounting standards. So you can understand that is the reason why the auditor cannot take up the role of the director of that company. Otherwise, we will have what is known as self-review. In other words, I'm the independent auditor, but I'm going in to review my own work. That would not be desirable and also would not be acceptable. So that's the reason why, according to the examiner, the candidate should also have mentioned statutory auditor as well. Also, if a person is subject to a disqualification order, then of course cannot. Okay, so what is a disqualification order? So this one would be covered in the market misconduct insider dealing part of the syllabus. And one of the possible penalty, if you will, that can be handed down to a director of a company who did insider dealing would be a disqualification order. Obviously, there are other situations where such order can be handed down, but that's one example that I can think of as part of this syllabus. So a disqualification order basically means that person cannot be a director of a listed company or cannot become a director of a listed company. So if you're existing director of a listed company, you immediately lose your job as director of the listed company. But if you're under a disqualification order, then no one can nominate you to be a director of a listed company. Even if they did, once people do the background check, they'll realize you have that order, they will not appoint you. Okay, so disqualification order is just an example, but you can understand this is what the question is asking for. Who would not be eligible to act as a director of the company? So if you're under such disqualification order, you would not be eligible. So according to the examiner, some candidates reviewed the grounds under which a person may be disqualified as a director. So that's additional information. But that additional information is not required by the question. So that's why for Section A question, have to be very careful. Number one is only worth 5 marks. So the time you spend must match the number of marks allocated for that question or that part of the question. There are 100 marks available in the exam, if I recall correctly. And let's say if you have 3 hours, you can understand you will have around 1.8 minutes per mark. Multiplied by 5, then that's about 8 minutes, okay, 8 or 9 minutes. So if I only have such a short amount of time, I want to focus my answer or only answering the question at hand and not try to go further. Otherwise, you risk writing additional information which will not score you marks, but at the same time, likely to lose time that you can use for other questions. So as an exam technique advice, always focus on how many marks is available. If it's only 5 marks, you want brief, concise answer that specifically answer the question at hand. Okay, let's move on to question number 2 from the June 2022 exam. So here you can see is asking about the difference between de jure director, de facto director, and shadow directors. So we just went through that, but it's good to see it came up as a question in June. So candidates were required to explain the difference between the de jure director, a de facto director, and a shadow director. Many candidates confuse the concept of a de jure director with a de facto director. Okay, so it's understandable because these are French. So many people, including myself, not well versed in that language, but you can see the spelling, at least the beginning part, they're similar. One is de jure, the other one is de facto. So it's understandable, okay? But now that you have gone through this workshop and you have reviewed the materials, hopefully it would not be difficult to see there is clearly a difference. The first one, de jure director, is officially appointed directors of a company. So these are the standard straightforward ones that we normally see. Okay? De facto director, most important, they are not officially appointed as a director of a company. Okay? It's entirely possible they were a director of a company, but they retired or they resign or they are no longer eligible. Can be any one of the above. Most important is after they are no longer a director of a company, they continue to behave as a director of a company. Okay? So how can someone behave as a director of a company? Very simple. Maybe that person go and meet with the customers and meet with the suppliers to negotiate contract on behalf of the company. So from the outsider point of view, they may think, everything is normal, same as before. You were previously a director, now you continue to behave in the same way. They assume you are still a director of a company. So from an outsider point of view, they may not know. Okay, so some of you who are very clear on the practical aspects, you can say, all I need to do is go to the CR website, click onto that company, and I can see currently who are the directors of this company. And you will be absolutely correct, but not everyone will do that. Okay, some people, I'm used to dealing with you every month. I have my meeting with you this month and we negotiate a contract. It's the same as before. So they may not be alerted to the fact that maybe that person is no longer a director of the company, so they do not go and check. Okay, another thing, of course, is there's a time limit for updating the CR. So it's entirely possible from there's a change of situation to the time the CR received the update and published the new information, the public may not be aware. So that's the reason why this concept came about, is to protect outsiders who are dealing with directors and they may not know that person may not be officially appointed as one. Then we move on to the final sentence. Only a handful of candidates were able to explain the concept of a shadow director. So this will not be difficult for you now because you attended this workshop, you now know. Again, shadow directors are not officially appointed directors of the company. Okay? De jure directors are, shadow directors are not. So how do they come about? Well, imagine there are all these directors sitting on the board, but every time they discuss something or they vote something, it's actually based on instructions from someone behind the scene. Okay? It may be a controlling shareholder, maybe someone who has a lot of influences, who knows? But if someone else, they are actually controlling these directors based on company law, that individual or that entity, because it can be a company, is a shadow director. Okay? So some of you may wonder, so why is that important? Why do we need to know? Well, if everything goes smoothly, yes, maybe we don't need to know. But if something went wrong, for example, the contract end up being disadvantage to the company, maybe causing the company to be insolvent, and subsequently the company is liquidated, then the liquidator would want to know, are the directors on the board acting under the instructions of a shadow director? And if the answer is yes, it may be possible for the liquidator to go to court and claim against the shadow director if there was some acts that is actually not to the interest of the company or against the interest of the company. So you can see a lot of these concepts normally may not be as important, but if something did go wrong, you need to make claims and ask people to pay or compensate, then you would want to find out about them. Okay, so let's look at question 3 of the November 2021 exam. So explain who has the power to appoint a director and how this is exercised. So I briefly touched on this just a moment ago, but it's okay, we can look at it again. So first, let's look at the examiner's comments. Candidates were expected to identify the parties who have the powers to appoint a director and how this power is exercised. So you will recall I mentioned before is usually it would be the shareholders in general meeting who would appoint a director. So how would you know that? All you have to do is ask yourself, why do we have directors? So directors are there to manage and run the company on behalf of all the shareholders. If you understand that, then it would not be difficult for you to conclude then who would appoint a director? Of course, it will be the shareholders. So shareholders individually would not have power, they would not be recognized under company law. But for this matter, it will be the shareholders in general meeting. So during the general meeting, all the shareholders, they would attend and they will say, okay, these are the people who we nominated to be appointed as a director, or if they retire, they come up for reappointments and they will decide whether they approve or not, and they would vote. And if it's possible, they pass the resolution and it's only an ordinary resolution required, then those people can become directors of a company. Okay, so just for as a reminder, you will recall ordinary resolution is where you have more than half the votes. Okay, so the threshold is more than 50%. So 51% is more than 50%. If you have a lot of shareholders and the shareholding is very widespread, then 50.1%, technically speaking, is more than 50%. Okay, so that's ordinary resolution. Whereas previously we talked about alteration of articles, you need a special resolution. Special resolution is you need 75% or more of the votes in order to pass. So generally speaking, for more important matters, then the threshold will be higher. So obviously, if you want to vary, you want to amend the content of your articles, your constitution, you would expect the threshold to be higher. You would not expect to be lower. But for appointing directors, the threshold is only ordinary resolution more than 50%. Okay, let's continue to read on the comments from the examiner. So most candidates simply outline the procedures of how a meeting is called and the function of a nomination committee in a listed company, but did not identify the parties who have the power to appoint a director or how this is exercised. So this is a good example of sometime candidates in exam condition, maybe they're a little bit nervous. They read the question very fast. And maybe because they feel there's a time limit, they immediately answer the question. But they did not read the question carefully. So you can see here, say, explain who has the power to appoint a director. Okay, so they really would want to know which person or which entity or which organ has the power to make the appointment of a director, and then how it is exercised. That's what the question is asking. Now, you can see some of the candidates, according to the examiner, outline the procedures for calling a meeting, calling a general meeting. So even though it is true, you need to call a general meeting in order to appoint a director, that's additional information not asked by the question. So if you wrote answer on the procedure for calling a general meeting, it's not really answering the question, especially when it's only a 5-mark question. Some candidates also discuss nomination committees. Now, it is correct for a listed company, a nomination committee can be formed and they would decide who to nominate, for example, as a director, executive director or independent non-executive director, and you can ask the shareholders general meeting to vote whether to approve or not. But that is something very specific for a listed company. So if you look at the question, there's no mention of listed company. So for a private company, generally, there would not be a nomination committee. Okay, you can say, is it possible for a private company to nomination committee? Of course, they can, but that's voluntary. But for some listed companies, it's mandatory that they have a nomination committee. So you can see the requirements are different, so you must go back to the question. What is it asking? If it's asking a general question, it's better with a limited time, with only 5 marks, to give a general answer first. Once you've done that, I believe your 5 marks time is already up. And you can go answer other questions. And let's say you finish all the other questions and you have time to spare, which has never happened to me. But if that happened to you, wonderful. Then you can go back to any of the questions you want to add a bit more information, extra bonus. It's like we call it icing on the cake. But there's no need to do that. If you have limited time, just answer the question as required and then move on to the next one. So here is clearly talking about the parties. Who has the power to appoint a director? So your answer should include shareholders in general meeting. Okay, so that would be a good answer. If you only say shareholders, it's only part of the answer, because a shareholder cannot individually or 2 or 3 or 4 of them appoint a director. They cannot. But shareholder in general meeting can. Okay, it's possible you only have 3 or 4 shareholders. It's possible you have 3 or 400 shareholders. So that's the reason why you need to say shareholders in general meeting. Can appoint directors, but of course during the year, if you have a casual vacancy, the board of directors also have the power as well. Okay, so why is that the case? Well, you can see that's common sense. In practice, sometimes that may be necessary to keep the business running, to keep the company going. So you cannot always wait till a general meeting is convened. So in that case, that's why for practicality purposes, is possible. The power is provided to the board of directors in those circumstances. Of course, if you're really diligent, so this is a practical point, is you would double check the articles. So the articles will clearly state if there are any restrictions or whether such a power is allowed or not. Okay. Okay, so let's now move on to some more topics under learning outcome number 2. So we previously looked at the different types of directors. Now we'll talk about the role of the board. So as I mentioned before, when it says the board, it means the board of directors. So the general function of the board is to manage the company for the shareholders. Okay, this is quite simple. If you're a small private company with only 1 or 2 shareholders, it's entirely possible the directors on the board are the same people as the shareholders. Entirely possible. But of course, they're wearing different hats, operating under different role when they vote or make decisions for the company. Okay? Now, if you read the study materials, you'll find there's actually 2 decision-making organs of a company. The first one, as I have discussed, is the board of directors. The second is shareholders in general meeting. Those are the 2 that would normally make the decisions for the company. So division of powers between board and members. So you may wonder, is it possible for the board of directors to disagree with the shareholders in general meeting? And the answer is yes, especially if there are many different shareholders or if the directors are not the same people as the shareholders. In that case, it's entirely possible that the board may make a decision the shareholders do not agree. Okay, so since the board of directors are charged with the responsibility of running the company and managing the company on their behalf, is it possible for the shareholders to intervene? Can they stop what the board is doing? Okay, so that's a very important question because if the answer is yes, then you start to wonder, can you rely on the decision of the board if it can be overridden by the shareholders all the time? There's also a practical matter is how often can the shareholders convene a meeting to make a decision to, let's say, overturn the decision of the board? So if you have a few shareholders, you can do that all the time. But if you have hundreds or thousands of shareholders like a public company or publicly listed company, not so easy. So that's why to answer the question of division of powers between the board and members, you need to ask which version of the constitution is being used by the company. So that may sound a bit strange. It's because of a bit of history. Long time ago, prior to the new companies ordinance, we have something called the, as I say, the memorandum and association and articles of association. So it's the M&A. So back then we have something called a Table A, which tells you about under what situation the shareholders in general meeting can basically intervene and maybe overturn the decisions of the board. And the main question that was asked is what is the threshold? Is it just an ordinary resolution or a special resolution? Now you can imagine if you only need an ordinary resolution for the shareholders in general meeting to overturn the decision of the board, you only need less than half of them to say yes. But if the threshold is a special resolution, which is 75% or more, not so easy to pass that resolution, especially if you have many shareholders and if they share different views. Okay, so that's very important. So anytime we see a dispute, even for a company today, you still need to find out which version of the constitution are they using, because they have every right to maintain the same one since they were incorporated, which was a long time ago, as long as it does not contravene the law or the company's ordinance. However, for the newer companies that was established under Cap 622 in Hong Kong, in that case, it's very clear. Okay, in that case, it's clear that the threshold will be special resolution. The shareholders in general meeting can override the decision of the board during the year by a special resolution, which is 75% or more. So it's trying to balance the two because it's hard for the company to run and carry on business if the shareholders can so easily and frequently interfere, because sometimes not all shareholders want to do that. Sometimes it's just a few of them, for whatever reason, maybe personal reason, they would want to stop the board from carrying on business for the company. So I guess that's one of the reasons why the threshold will be higher. Okay, so rules relating to board meetings. So you have two types of meetings. Board meetings is meeting of the board of directors, where a general meeting is the meeting of the shareholders in general meeting. So for board meeting, you can understand is probably the requirement is not as high. It's not as strict as calling a general meeting. Why is that? Well, because the directors are supposed to be managing the company anyway. They're supposed to be there. So calling a meeting, you may not need to give them weeks in advance to have a meeting. It'll be very hard to run a business. So that's why for calling a meeting, the timeline or the number of days notice required is much shorter. Okay, generally speaking, if it's not stated in the articles, it's just a reasonable amount of time. So for example, if I want to call a meeting, it's 12 o'clock now, let's have a meeting at 2 o'clock in the afternoon. It's possible. The court, looking at all the situation and circumstances, may say 2 hours is a reasonable notice. Whereas for shareholders, if you call a shareholders meeting and you give them 1 day notice, the court may say, that notice is too short. You need to give 14 days for a general meeting. So it's different context, different people, and that's the reason why it's slightly different for board meetings. Quorum. The word quorum basically means the minimum number of people attending a meeting so that the decision made by that meeting will be held to be valid and enforceable. Okay, so board meeting, the quorum, again, you will want to go look at the articles, see if it's stated. If not, then you will go look at the ordinance. Generally, the quorum for meetings will be 2, because if you hard to have a meeting by yourself. So that's why generally quorum will be 2 as a minimum, but some articles, the quorum may be 3, maybe 4, so that's why I always need to check the article. Now, if there are not enough people to attend, then the chairman can say we may need to adjourn the meeting to another week. Now, board decisions. So if there was a resolution proposed to the board, they all voted yes or no, the outcome will be the decision of the board. The board can decide not to carry out with that particular proposed resolution, or the board can say, yes, we approve it. Okay? Minutes of meetings. So this is very important because it records the discussion and, more importantly, the decision of the board as they consider all the different resolutions. So it's a record of the decision-making process and the outcome of each of the meeting. So some of you who have been engaged in this in practice will know minutes of meeting obviously is not writing down what everyone has said. It's not a transcript. The most important purpose of the minutes of the meeting is to demonstrate that you have discussed something that needs to be discussed by the board, and they have considered it and they have voted it in accordance to the articles and ordinance, and they have an outcome, they have a decision. So that's the record of the meeting, the minutes. Okay, then we have company secretary. So a very important role. Nowadays, even more important. Why? Because as you may notice, we now have more and more regulations on everything. So one of the main role of the company secretary is to assist the board to ensure that the company complies with all these different regulations. At the start, of course, is all the regulations under company law, whether it's CAP 622 or CAP 32, definitely. But if you're a listed company, as mentioned at the beginning, you also need to comply with listing rules, the different codes, the corporate governance, many things. So that's why it's very important. So that's why when you appoint a secretary, company secretary for a listed company, then must satisfy the qualification requirement. So the qualification requirement of a company secretary for a listed company is either you are a lawyer under the Legal Practitioners Ordinance, or you are a CPA under the Professional Accountants Ordinance, or you are a Chartered Secretary under the HKCGI. So all of you, once you get your qualification, would qualify to be a company secretary if you so wish. So role and powers of the company secretary, I think I briefly mentioned before, but it is important to understand is a company secretary, just like a director, is an officer of the company. Okay, so in some situation, the company secretary would act as an agent of a company, can enter into contracts on behalf of the company, and it will be binding on the company. Okay, but it is important to understand the difference between the role of a director and a company secretary. Director would generally manage the business of the company on behalf of the shareholders. The company secretary will look at compliance, look at regulations, and more the administrative side. So that's why if the company secretary do indeed enter into contracts on behalf of the company, you need to look at the nature of the contract to decide whether it is binding on the company or not. Okay, moving on to the next topic under Learning Outcome 2 is director's duties. So director's duties is a very common topic to be examined for company law for obvious reasons, because you have directors who are running a company on behalf of the shareholders. So you have expectation that they need to act in the interest of the shareholders. And if they do not, there should be some consequence or some way to stop them. So that's the reason why we have director's duties. On the screen, you can see there are many different types of director's duties. A common mistake I have noticed sometime when I look at the past exam performance, in the feedback, I look at the reports, is some of the candidates do not know the difference between the different types of duties. So in the exam, sometime what would they do? They try to write down all of the duties. Okay, so this is not advisable from the point of view of exam technique. Why? Because of limited time. Let's say there are many different types of duties. Let's say only one or two of them is relevant to the story, to answering the question. Now, if you only spend time writing about two of them, wonderful. You get a good mark, you don't use up too much time. But if you try to write every single one of the duty, hoping some of the answer is correct, you end up spending more time than you need, but you do not end up getting additional marks. So from a time management point of view and to providing relevant answer point of view, it is not advisable to do that. So in your revision, my suggestion is try to understand the difference between each of the duties, so that when you look at the different exam questions in your practice, you can already know, I know that one is about power for proper purpose and also to avoid conflict of interest. Okay, sometime maybe one, sometime maybe two. I've never seen a situation when it's all of them. Okay, and I would doubt that would be the case, because there are so many different topics to examine in company law. I'll be surprised if the examiner will expect you to spend only so much time on director's duty. So I expect it will be one of the topics being examined, but I think you will need to discuss many other topics as well. So let's get started. What are the differences between the duties? First one, duty to act bona fide for the benefit of the company as a whole. So what does it mean by bona fide? Bona fide simply means, it's translated from Latin, good faith. Okay, act in good faith for the benefit of the company as a whole. So let's look at this one part at a time. First of all, act bona fide for the benefit of the company. Okay, when the director did something or chose not to do something, was it for his own benefit or benefit of the company? That's first part you would keep in mind. The second part, of course, is benefit of the company as a whole. This is very important. Let's say you are a majority shareholder. So you may argue, what I did is beneficial for the company because I'm a shareholder as well, so it's fine. But is it beneficial to the company as a whole, including the consideration of all the shareholders as a whole? If the answer is yes, it is okay. Otherwise, it may amount to a breach. So that's why if you're acting in good faith for the benefit of the company as a whole, you're complying with one of the director's duties. If you did something that's not the case, of course, it will be a breach. Now, let's move on to the second one, power for proper purpose. How does this come about? Well, first of all, you would understand is directors do have a lot of powers. The board of directors can enter into contracts to buy goods from other people. They can lend money to other people or other companies, financial assistance. Okay, so having so much power at hand, the duty will be for them to exercise the power for proper purpose. Are you using your power for purpose which is not proper? So for example, I'm using my powers so that someone I do not like on the board will not receive any money, will not receive remuneration despite working for the company for a whole year. That's just a simple example where you're using your power but not for proper purpose. The third one is to avoid conflict of interest. So if I am a director on a board, I should try to make decisions and enter into contracts that is in the interest of the company as a whole. Okay, that's the first duty. However, it is entirely possible for the situation to have a possible conflict of interest. Let's say I am negotiating a contract with another company to sell goods to that company. Let's say I own some or all of the shares in that other company. In that case, when I negotiate on the contract, there would be a conflict of interest. Why is that? Because if I want to sell to you, generally speaking, I would want to sell at a higher price. However, if you are the buyer, generally speaking, you want to buy at a lower price. Now, of course, despite high price, low price, you still want to consider quality of the product, durability, maintenance, of course. But generally, the interest in terms of, for example, pricing and other terms, it will not be the same. The wishes of the seller most likely would not be the same as the wishes of the buyer, but they must come to a compromise in order to reach a deal. So if I'm the director negotiating a contract on behalf of my company, there's a potential conflict of interest. The question would arise, am I negotiating to benefit my company, which means sell at a higher price? Or am I trying to negotiate so it will benefit the other company, which I happen to own as well, which is to buy at a lower price? So that would be a potential conflict of interest, and I believe it's actually an actual conflict of interest as stated in the different court cases. So what can you do in that situation? Very clear. The good simple answer in many of these cases in company law is simply disclosure. Very clear. If someone asks me to negotiate a contract, I will inform the board, meaning I will tell the other directors on the board, I actually own shares in that other company. Maybe I would not be the best person to negotiate a contract on behalf of our company. In that case, they can go appoint someone else or ask someone else to go do the negotiation, and then no conflict of interest. So you can see a lot of the time is disclosing and notifying is the best way to do it. Other times, of course, is after I disclose, they say, we understand, we know it is fine, and they approve it, it is okay. The one thing you cannot do is keep quiet. If you keep quiet, you do not disclose, do not let people know. Once the deal is done and subsequently they found out that I actually had an interest in the transaction and I did not disclose, I would have breached the duty to avoid conflict of interest. And then, of course, the company can, if it chooses to, rescind the contract. Okay, to the next one, duty not to make secret profits. So goes back to the original idea that directors are supposed to be managing the company and the business on behalf of the shareholders. In that case, should be making profits for the company. Okay, you should not try to have a deal which would result in more profit for yourself. The shareholders and the board would not expect you to do that. So if you did make a profit, it will be a secret profit. So again, if you had disclosed and let them know and the shareholders approve in general meeting, which would be rare, but it's possible. Okay, but if you kept quiet and it remained a secret until someone discovered, then it's entirely possible they can claim against you for breach of the duty not to make secret profit, and it's possible they can require that you disgorge your profit. Disgorge basically means you give the profit back to the company because that really belongs to the company. Okay. Another one is duty not to usurp corporate opportunities. So this duty is talking about all the different opportunities that you became aware of or able to obtain because of your position in the company. So let's say you are the managing director of a company. By being managing director of the company, you became aware of many business opportunities. Maybe those opportunities were presented to your company and you only found out about them because you were managing director. So in that case, you have a duty not to usurp those corporate opportunities. Usurp basically means steal or take away the corporate opportunities belonging to your company. Okay, so it makes common sense you cannot do that. Of course, you cannot steal. So you cannot steal opportunities from your company. But this duty is quite unique because based on different case law, it's saying you should not steal the opportunity, even if the opportunity, let's say your company do not want it or your company would not be able to obtain it. So in a very famous case where there was a situation where the other party already told the managing director they do not wish to grant the contract to the company, but if the managing director opened up his own company, they will grant to him, to his own company. Okay, so it's possible for a managing director to say, the other party already said they will not give it to this company, so I'm not stealing. But for the concept of duty not to usurp corporate opportunities, the directors have a responsibility to disclose to the company. In other words, what should that director have done? He should have gone to the board and say, guess what? I discussed with our customer. The customer said next year he will not give us the business, but if I open up my own private company, he will give me the business. He should say that to the board and let them, number one, be aware of it, and number two, if they're approved, everything is okay. Okay, so it may sound strange, but at the end of the day, you need to remember is the director has a duty to the company first. He or she was appointed as a director for the company, so that's why he cannot act against the interests of the company. Okay, so after looking at all those duties, and they are mainly from case law, there's one where it's in case law, but it's actually encoded in the company's ordinance, section 465. So this one need to pay special attention because this one often come up when you are a director of a company and you need to be very careful in the decision making. So if you're not, this one can come up as well. So duty to exercise care, skill, and diligence. So as a director of a company, it is expected that you do your job carefully, using your skills, and you check carefully before you make decisions. So that's the reason why we have this duty. Based on this duty in section 465, there are two criteria. The first criteria is an objective test. What does it mean by objective test? It means if a reasonable person was taking up your position doing your job, that is the level of care, skill, and diligence we would expect from that reasonable person. So if what you did was less than the reasonable expectation, they can say you did not comply with that duty. Okay, so that's the objective test. But there's also a subjective test. What does that mean? Well, subjective test takes into account your knowledge, your skills, and your ability. So let's say you are an expert in finance. Let's say one of the reasons why they hire you was for financial matters. Then the expectation on you on finance related matter would naturally be higher than the objective test of the reasonable person who may just be a lay person without the financial expertise. So that's why they would take into account the objective test, and if you have some special knowledge or skill, they will also add the subjective test in order to decide whether you have complied with this duty or not. So this one is quite interesting, and how to apply this duty will depend on the story. If the story do not mention at all any special skills, special knowledge, then you can just use the objective test, it is okay. Even if you use the subjective test in addition, you still get the same answer because there's nothing extra you need to add to it, okay? All right, transactions requiring members' approval. So here is talking about disclosure again, okay? You have something maybe out of the normal business context, or maybe you have a loan to maybe a company, maybe a related company. What do? The easiest thing you can do is disclose. Inform the members in general meeting and let them vote to see whether they approve or not approve. Okay, so for example, if there's a director about to retire and you need to make a or not retire, let's say you need to remove that director because for whatever reason, and you decide you need to make some compensation payments for loss of office, then if you obtain the approval, then you will feel a lot safer because the shareholders have been made aware of the special arrangement. They listen to the details and they also approve. Generally, that will be the smart thing to do. If it was all in accordance to the contract and the articles, then of course it is okay. But if it's something out of the ordinary, it's always better to disclose and get approval from the members. Okay, we now move on to learning outcome 3. Here is about membership. So we've talked a lot about directors, but of course it's important to talk about members as well. So defining membership. So what is a member? Obviously, members are people who I would say they are the owners of the company. There will be some requirement. How can you become a member? So generally speaking, of course, if you hold shares in a company, you can be a member. But it's also possible for a company not to have issued shares. Then you must be a member going through the proper procedures. Then moving on to the next topic, which is closely related to the first one, is the register of members. Okay, so this is very important is because based on the company's ordinance, you are only legally a member of a company when you're on the register of members. Okay, so this sounds very administrative. So simple. Just write my name on the register and I'm a member. Yes, it's simple to do, but sometimes there can be arguments. You may not be on the register even if you purchase the shares from an existing member. Why is that? It's because it is normally the directors who will decide who is added to the register of members. So if there was a dispute between the directors and maybe one or more of the shareholders, it's entirely possible for the directors to refuse to register a new member. So if that person is not added to the register of members, then legally that person is not owner of the shares and then will not be entitled to the rights of a member. Okay, so what are the rights of a member? So there are many ones, but I would put it into two broad categories. If you're a member of a company, number one, you can vote in general meeting. That's one of your rights. Okay, so if you purchase shares in a company but you're not on the register, strictly speaking, you cannot vote. If you voted, your vote will not be counted. Okay, that's number one. Number two, as a member of a company, you have a right to receive dividends that is declared and paid to each member of the company. Okay, obviously on a pro rata basis, based on how many shares you hold. So again, if you purchase shares in a company, but you're not yet on the register, then they will not pay the dividend to you. They will not know how to pay to you because you do not exist on the register. So that's why it is an important point. It's not difficult to write or add your name on the register, but depending on how your company operates, unless and until that is done, you cannot exercise the rights of your members. Okay, inspection of register. So if you have a register of members, register of directors, register of charge, where can you find it? Well, let's focus on the members register because that one is the most common. It should be at your registered office. So when you first set up your company, first incorporated, on the form you already told the CR the location of your registered office. so that if the CR needs to notify you for something, they would send, that will be your contact address, okay? But there is some flexibility provided. In other words, if for whatever reason your register of members is not placed at your registered office, it is possible to be placed in a prescribed place. Prescribed place is basically a place that you name and you inform the CR, okay? So it is permitted, but if you look at the regulation 622I, the prescribed place must be in Hong Kong. Okay, so the location is important because you would want to be able, if you are a Hong Kong company, your registered members need to be in Hong Kong so that they can come take a look at it. Okay, transparency and membership. So it goes back to the register. As I mentioned earlier, if you are only the legal owner of the shares in a company, if you are included in the register of members, so that's legal ownership. Okay. However, sometimes the person named on the register of members is not the actual owner of the shares. What does that mean? It's not the real owner. It's not the beneficial owner. Okay. The concept is similar to the nominee director. Someone named as a director of the company, but in name only. Okay, so it's entirely possible for someone to be named as a member of a company, but in name only. Why? Because that person or entity is holding the shares on behalf of someone else. Someone else has the beneficial ownership of the shares, meaning every time they pay dividend, the dividend will be paid onwards to the beneficial owner. Anytime there's a voting at a general meeting, is the beneficial owner instructing the member how to vote. So that would be an example of the member basically just in name only. Now, that's the reason why we have something called a Significant Controller Register, SCR. So this is very important for AML CTF, anti-money laundering counter-terrorist financing. Okay, very important because sometimes when they want to trace money laundering, you cannot really find out who is the beneficial owner, because in the past we only have the register of members, so you can only see the legal owner, the legal member of the shares. And if you want to find out who is behind the scene, who is the one really controlling the shares and therefore controlling the money, you cannot find out. So the SCR is basically requiring the company to list out the beneficial owners, the people behind the scenes. So there's a 25% threshold. So you need to own enough shares in order to fall under that requirement. But it's a first step in the right direction in order to tackle AML CFT. Okay, then moving on to termination of membership. So we covered this before. How can you end? Under what situation will you no longer be a member of a company? So the most straightforward and most common way is when you sell your shares. Okay, I'm a member of a company. I sell my shares to someone else. That person becomes the new member of a company. I'm no longer a member of the company if I sold all the shares I own to that person. Okay. Second possibility is I give back the shares to the company. Okay, it's entirely possible the company has a buyback and then they will pay me the money, return the capital to me, and I basically give the shares back to the company. That is permitted. Of course, you must go through the relevant procedures. Okay, so let's take a look at some past exam questions. So these are the ones I saw in the past paper in section A, so we can look at them one at a time. Let's look at question 5 from the June 2023 exam. Who has the rights to inspect a company's register of members? List the information required to be included in the register of members. So let's look at the comments from the examiner. Most candidates recognize that members of a company have the right to inspect the register of members free of charge, while any other person may inspect the register on payment of a fee. So you can see it makes sense. If I am a member of a company, Of course, I should be allowed to inspect the register of members, and I should be able to do it free of charge, meaning the company should not charge me money for that. However, if I'm someone who's not a member, so let's say an outsider, in that case, I should still be permitted to inspect the register, but I need to pay a prescribed fee and make the request under using the prescribed method as required by the company. So some may say you have to fill in a form, have to pay a prescribed fee, and then they'll let you inspect. So most candidates demonstrated an awareness that the registered member should include the name and address of its members, the date on which each person is entered into the register, and the date on which they cease to be a member. Okay, so you can understand from the point of view of a member. When I first become a member, I am added to the register of members. So in their record, you will expect they will have the date in which I became a member of the company. Subsequently, let's say I sold my shares. Then on the register, you expect them to write down the date in which I ceased to be a member of the company. So that when it comes time to voting, when it comes time to paying dividend, they'll make sure the right people are included, and those who should no longer receive the payment will no longer be included. So that's why those information must be there. However, only a few candidates explain that in the case of a company having a share capital, the registered member should also include a statement of shares held by each member and amount paid. So you will notice is in the company's ordinance, we do not see the term shareholders. Not that I can recall. Okay, you only see the term members. Why is that? It's because we have different types of companies. Some companies have share capital, some do not. Of course, in practice, most do. So that's why we're used to that. Okay, so that's why they say for some registered members, they do not share capital, they do not need those additional information. However, if the company do in fact have share capital, then the register must include a statement of the shares held by each member. So how many shares on issue? Let's say the company has issued 100 shares. Then who are the people holding all those shares, adding up to the total of 100? Also, it should record the amount paid by each of the member when they first purchased the shares and became a member. So those are the additional information if your company do have share capital, which most do. Okay, so now let's look at question number 1 from the November 2022 exam. So when will a person have significant control over a company for the purpose of the significant controllers register? So according to examiner, most candidates correctly pointed out that a person who holds more than 25% of a company's issued shares or voting rights will have significant control over the company. Okay, so for practical reasons, they have a threshold. Okay, only if you have up to a certain percentage of ownership will you be required to do that. And that's for practicality. Imagine every single shareholder, including if you only hold 1%, you must still go all the way back to beneficial ownership. There will be a lot of work by the company to comply with this requirement. So they need to balance the needs of AML and they also balance the needs of practicality. They still need to try their best to comply, and you want the requirement to be reasonable. So most candidates correctly mentioned that is the 25% threshold to be treated as having significant control, and therefore you will need to show the beneficial owner. However, only a few clarified that trustees of a trust or members of a firm that is not a legal person, but which meet the above 25% requirement, would do if they were individuals and have the right to exercise significant control will be included as well. So these are just the odd situation. What if it's not the straightforward owning of shares in the company? What if it's held by trusts or by trust on behalf of members? Then that's the additional requirement. So obviously it is wonderful if you can include all of those information, but if you did not have enough time, at least answer the first part about the 25% if you see a similar question. Okay, if you see a question it is slightly different in wording, then read it carefully. Do not just give the same answer if the question is not the same. Okay, so let's now look at question number 5 from the June 2022 exam. So explain the distinction between a shareholder and member of the company. So I might have touched on this earlier. So here is talking about whether the company has a share capital or not. So for example, if you are a private company limited by guarantee, that would be an example where your company do not have share capital, and that's the reason why you will only be a member of a company and not a shareholder. However, if you are a private company limited by shares, then of course each of the member would also own part of the company in terms of how many shares they own. Then of course you can also be known as a shareholder. Okay. Now, even if you're a company limited by shares, you are still a member because the ordinance and articles only refer to members. Okay. But in addition, it is okay to refer to you as shareholders as well. So here they say only a few candidates managed to explain the relevant concept and to distinguish between the two. So it is okay now because if you have attended this workshop, you already know this one and you already read the recommended or suggested answers from the examiner. So this would not be a problem for you should this question come up again. Okay, we can now look at the next topic under Learning Outcome 3. So company meetings and decision making. So first one is decision making by private and public companies. So private companies, you do decision making. In most cases, you would comply with the company's ordinance and you will comply with the relevant case law. Okay, for example, no duty not to have conflict of interest. There will be an example of also complying with the case law as well. However, decision making by public companies, the situation may be different because if you're a publicly listed company, then you will also need to comply with the listing rules. Okay, so for example, if your listing rules for certain decisions, then they will say the voting can only be voted by independent non-executive directors or shareholders who have these type of situation must abstain from voting. So these would be good practice for private company, but it's actually mandatory for public listed companies. So that's why anytime you see a question, if it mentions specifically, if it's a private company or if it's a publicly listed company, then your answer may be slightly different. If it doesn't mention, if it just say what is the difference in decision making for the board and for the shareholders, then you answer generally first. And I think that will be a good start. And then depending on the information provided, you will go further only if needed. Okay, then the next bullet point is resolutions and unanimous consent. So resolution I've touched on briefly before is what is the threshold requirement? How many votes do you need to pass that particular resolution? So if it's an ordinary resolution, you only need more than half of the vote, which is 51% or 50.1%. So anything more than 50%. If it's a special resolution, then you need 75% or more. However, there's another concept which I don't think I've discussed yet, is unanimous consent. Unanimous consent basically means 100% said yes. Everyone agreed, no one said no. Okay, so there are different requirements. So for example, some situation where you do a written resolution, then you will only be permitted to do so if you have unanimous consent. Everyone said okay. Then we have rules for general meeting. So previously we talked briefly about the rules for calling a board meeting, but this is now talking about general meeting for shareholders. So calling a meeting, you have to see whether it is a general meeting or is it AGM. So obviously general meeting is 14 days notice requirement, whereas the AGM is 21 days notice requirement. Now, of course, it's possible for the shareholders to agree to short notice, but you start off with the basic requirement first before you look at specific situation. Now, in terms of notice, as you understand, we now move in modern times. We have new technology and convenience. So that's why in the past, some of the requirement you might have to fulfill by hard copy, by postal. but now many things can be done by electronic communication. So is it possible to make a call notice to call a meeting? The answer is yes, you can do it electronically. It's now even permitted, you can have it sent to them by email and also permitted to have it on your website. So you must comply with those specific requirements, but they have updated the ordinance to allow for that. Also, you have quorum. Is the same concept as for board of directors, but obviously we're now talking about shareholders. You need to check the articles to see if there's any specific requirements. If not, then the quorum may be 2. Okay, that's the standard one, because for a private company, it's entirely possible. You only have a few shareholders, so quorum for 2 is possible. But if it's a larger company, then the quorum may be higher. Okay, it may be 10, maybe 20, maybe 50% of the shareholders on the register. It all depends on what the shareholders agreed upon. Okay, so then after that we have the voting. So if you have a general meeting, you make a proposed resolution for the shareholders to consider, then they will need to vote. So there are generally 2 ways you can go about doing this. Number 1 is voting by show of hands. So everyone attend the meeting and the chairman say, who would agree? And you just raise your hand, that's all. And visually, the chairman look at the room, almost everyone has their hand up. Do we need to count the vote? The answer, no, we don't need to, okay? But if it's not clear, or if someone demanded a poll, that means we need to count the vote. In that case, it is not counting hands. It's depending on how many shares you own, you will vote, and then they will count all of the votes, and they will actually announce the result. How many votes say yes, how many say no, and whether we have passed the required threshold. So voting is important because it's the decision-making process. So if there's some irregularity, then someone subsequently can go challenge the decision. So for example, if someone demanded a vote and for whatever reason the chairman said no, then unless he has a good justifiable reason, the decision making can be challenged. So have to be careful there. We have the annual general meeting, so it's a requirement in the company's ordinance. All companies, unless they're exempt, they must hold an annual general meeting at the end of each financial year. So why would you need to do that? Well, the directors manage the company on behalf of the shareholders. So there must be some mechanism for the shareholders to report, for the directors to report back to the shareholders. So for example, how well have you done this year? So that's the reason why they would lay the financial statements to the shareholders in general meeting. Basically, let them see your report card, see how well or not well you have done. So you will need to do auditing first, of course, but once the audited financial statements are finalized, then it will be presented to the shareholders, and the shareholders can see how well or not well they have done. And that's quite often will be related to their decisions on whether to reappoint the directors. Okay, so if the directors did a bad job year after year, so when they come up for reappointment, it's entirely possible the shareholders decide maybe we want someone else, entirely possible. So AGM is a way for the directors to report back to the shareholders, but also for the shareholders to make important decisions, such as whether to reappoint the directors and whether to appoint or reappoint the auditors for the coming year. All that will be done at the AGM. Adjourning a meeting. Adjourning a meeting simply means let's stop the meeting now and continue it later. That's basically what adjourning means, okay? So under what situation would you adjourn a meeting? So there can be a number of different situations. The most common one is where the chairman realized they do not have sufficient quorum for the meeting, okay? So as I mentioned earlier, if you do not have enough people attending a meeting, you do not have quorum, you have not met the minimum number, then any decision the meeting makes may be challenged as being not valid. So that's the reason why if a chairman realizes there's not enough people attending, let's say the meeting is at 6:30, it's now 7 o'clock, we still not have enough people, then the chairman may say, I now adjourn the meeting. And based on the ordinance, it was typically say we will adjourn to a subsequent time, maybe same day, same time, and then we'll see if enough people attend. and if not enough people attend, it is possible for the chairman to declare we still be deemed to have enough quorum, and then we will continue with the business of the meeting. So all these procedures are important, and that's why if you're chairman of the meeting, then you must make sure you adhere to all those procedural requirements. Okay, the next one is records of meetings and resolutions. So records of meeting, we discuss a similar item for board meetings. So the records of meeting, I would normally expect it to be the minutes of the meeting. Okay, but that's just a name, and it's basically not a transcript of what everyone has said, but it's basically clearly saying which item was proposed and explained to the shareholders, whether they voted by show of hands or by poll, and then what's the result, whether it's passed or not passed. Normally, we'll expect that to be seen in the minutes of meetings. Who stood for reappointment, and then who was appointed as directors and also as the auditor of the company. That's quite common as well. So resolutions are the individual resolutions we talked about. So whether it's a resolution to appoint a director, or resolutions to remove a director, or resolution to appoint an auditor, all that information should be there as well. Okay, then we have class meetings. So what are class meetings? So most companies only have one class of shares, which is ordinary shares. But it's entirely possible for some companies to have different classes of shares. For example, they may have type A shares, maybe has more voting rights, maybe have less voting rights, maybe have different types of dividends. For example, may have preference dividends, so they are paid before ordinary dividends are paid. So different classes of shareholders. So if you wish to make any changes, for example, alter the articles which affected the rights of the shareholders in a particular class of shares, then you will need to get their approval, get sufficient number to approve. So that's will be a good example where you have class meetings. Okay, members engagement and electronic meetings. Okay, so members engagement is members are owners of the company, but sometimes it is possible you may have hundreds or thousands of shareholders. So members engagement means that the directors, do they engage with the members? Do they communicate with them, discuss with them, find out what are their concerns, what they hope to be done? That will be members engagement. So from a listed company's perspective, it's now an expectation that independent non-executive directors, INEDs, also actively have members engagement. So they can, because they basically are there to help protect and ensure the interests of the shareholders, including minority shareholders. So if they do not engage with the members, do not discuss with them, how would they know what are their concerns and how can they go about their job to protect their interests? So that's why members engagement is important. And then electronics meetings, as mentioned earlier, is now with technology and convenience. It is expected that there will be a possibility for some companies to use electronic meeting. So some of them may use hybrid meeting, which is some people attend in person and some people attend online, but sometimes it is entirely possible that the entire meeting where everyone attend online as well. Now, that's the convenient part, but you still have company law. You still have the company law requirements. So for example, when it comes to voting, do the technology supporting the electronics meeting, is it sufficient to allow you to properly identify who has the right to vote? So if someone press a button to vote, is that person eligible to vote? So you must have some identification process, okay? Also, do everyone attending the meeting, no matter physical or online, do they have the same opportunity to vote at the time when voting is required? So for example, if you are there in person, your vote will be recorded. If you attend online, it's possible your vote may not be correctly recorded. That would not be right. So that's why that's the procedural part and the technical part. So the company law facilitates electronic meetings and recognizes electronic meetings, but you must also have those safeguards in place to ensure that the people attending online will have the same rights as those attending in person. Okay, so let's look at an example question from the past exam paper. Starting with the November 2022 paper, question 2. Explain who has the power to call a general meeting. So this is a 5-mark question. This is in section A. So the examiner in the comments is that most candidates correctly identified that the board of directors and members representing at least 5% of the company's paid-up share capital or at least 5% of the voting rights may call a general meeting. Okay, so this is very good. You can see the candidates did very well. The board of directors can call a meeting, definitely, because they run the company, they manage the company, and they will call a meeting sometime because they need approval from the shareholders in general meeting. Also, members, if they wish to call a meeting, maybe there's something that is concerned or they discover something or they want to remove a director and the board of directors refuse to call a meeting, then yes, the members can call a meeting as well. So members can call a meeting by asking the board of directors to do so, but if they do not, then the members themselves can. But you do not want frivolous call of meetings because it takes time, effort, and money to organize a meeting. So in that case, if you have hundreds and thousands of shareholders, can one shareholder call a meeting? Probably not. So the only fair way is based on percentage of ownership. So if members, meaning one or more of them, together hold at least 5% or more of the share capital, then in that case, the answer is yes, they can call a meeting. So 5% is not very high. Okay, it's not really that high. But of course, if you're a publicly listed company, 5% can amount to a lot of money. But it depends on the situation, but it would seem reasonable. Okay, because even if you are a publicly listed company and even if you have hundreds and thousands of shareholders, it still does not mean one shareholder can call a meeting, especially if that person only owns one parcel of shares. So that's why I think the minimum threshold has its reasons. Okay, then according to the examiner, only a few candidates pointed out that the auditor of the company and the court may also call a general meeting. So let's look at this one at a time. So the auditor, of course, is the one who is actually auditing the financial statements of the company. So if there was some problem dealing with the board of directors, they would not cooperate, and that's not in the interest of the company, it is possible for the auditor to call a meeting. Conversely, the court may order one as well. So if there were some disputes between the shareholders and or the directors, then it is possible they cannot call a general meeting because they refuse to cooperate. And if they ask the court for help and the court believes it is beneficial to hold a meeting, then the court can actually order that a general meeting be conducted. So in that case, most likely the court will issue the order to the directors, and the directors will have to do the job and arrange a general meeting for the shareholders. Okay, let's now look at members' remedies. So there's personal and corporate actions. So what are we talking about? So it's talking about if you want to make a claim or go to court, maybe against a company, who's the one who's making the claim? Corporate actions, of course, is the company doing so, whereas personal actions is basically for your own individual remedy. So am I saying the directors, they're acting against the interests of the company as a whole? Then most likely that's for corporate actions because you're acting on behalf of the company. Personal actions is where I believe I'm the one who has suffered losses and I want some compensation for myself, I want damages. That would be a personal actions. So the principle of no reflective loss principle, what does it mean? So if I am permitted, so it's not automatic, you have to satisfy some criteria. I can bring in action on behalf of the company. And if the court finds that, yes, they did something wrong, and then this is the amount of compensation needs to be paid, that is to repay the company or repay the shareholders as a whole. It is not basically to compensate the individual. So for example, if I say, they did something bad and the value of my shares went down, so I lost 100,000 because of the loss of value of the shares, I cannot ask the court to grant me that amount of payment. Then we have derivative action. So this is closely related to what I mentioned before, and it's talking about the rule in Force and Harbottle. What is that rule? is basically known as the proper plaintiff rule, which is who has standing, who has a right to lodge a claim. So in the context of the directors behaving incorrectly and causing losses to the company, then only the company would be the proper plaintiff. Okay, so if the company submit a claim to a court against the directors for doing something that's a breach of their duty, and then they are the one who needs to be sanctioned or need to compensate, that's the proper plaintiff. So can an individual, for example, one of the member of the company, go and file a claim? And the answer, generally speaking, under the proper plaintiff rule is no, cannot. Okay. However, there are exceptions to the rule enforced in Harbottle. So if it can be shown to the court that you have the directors who are abusing their power, not using it for the proper purpose, and then to the detriment of minority shareholders, then it's possible for the court to consider, for this one, it's possible for you to be permitted despite the proper plaintiff rule. Okay, but this is just allowing you to start the action. It's not allowing you to seek personal compensation individually. Okay, so why would that be a need? Well, imagine usually the board of directors are the one who would act on behalf of the company. So if the company wants to go to court to make claims, it will be the directors who would take action and lodge a claim on behalf of the company. But if the directors are the one who did the wrongful acts, they are the one being blamed, it will be very difficult to convince them to go to court to sue themselves. That's the reason why you have these situations, okay? Exceptions to the rule. Now, that's from common law, from the case law, Foss and Harbottle, and exceptions. However, under our CAP 622, there's also the statutory derivative action. That's an alternative route. Okay, so this one is under section 732, and if you satisfy the criteria, it is possible to lodge this one as well as suing on behalf of the company. Okay, so what are the criteria? Under what situation can you qualify to invoke this? Generally speaking, is if the directors are guilty of misconduct. Okay, so what's the definition of misconduct? If you look at the different cases, generally it will be breach of director's duty. That would be a good example of proving misconduct by the directors. So if you can prove that, then it's possible to launch this action. Okay, alternatively, you also have section 724. So 724 mentioned a little bit earlier before is the unfair prejudice action. So if you believe the directors, either by the way they manage the affairs of the company or due to one particular transaction by undertaking the transaction or omitting, meaning not taking the transaction, they behave unfairly and prejudicially against one or more members of the company, then it is possible to launch a claim under 724. So you must prove both. It is unfair and prejudicial, and that's discussed in the court case. But generally speaking, if you can see that they're diverting the assets of the company to benefit themselves. So for example, if they sold a lot of the assets at a low price to another company that the directors themselves own, that will be a good example. Their act is unfairly prejudicial to the members, especially the minority shareholders. Okay. Then we have section 177, petition to wind up the company. So you may wonder, what are you talking about? Liquidation, isn't that just when you want to seize the company at the end of the life of the company? Well, sometimes there are no other choices. That's the only thing left. So let's say the directors and the shareholders, they are in such disagreement, they really cannot agree with each other, and there's no way out. Then sometimes winding up a company is the best solution. Meaning, you repay all the debts owed by the company to the creditors, and then if there's any money left, you distribute to all the different shareholders based on their shareholding, and everyone go their own way. They will take the money and invest somewhere else or something else. Okay, so winding up sometime can be a good resolution to a difficult circumstances where there are no other ways you can resolve a particular situation. So that's why under section 177, there are different grounds. And if you can satisfy one of the grounds, then it is possible. So for example, Most common one we see for exam, but in real life it's not always the one, is when it's the just and equitable grounds. If you really believe, let's say you have some partners that you run a business together, and in the past you get to manage the business together and you have a good relationship, but suddenly the good relationship broke down and you can no longer trust each other and you will not even let me manage the business together, then that would be a just and equitable grounds under Ibrahimi Westbourne Galleries that the company would ask the court to allow, to order that the company be wound up and you distribute the money back to each of the owners and we each go our own way. So that's a possibility. Okay, so we're now on to learning outcome number 4. These topics deals with the area of shares and share capital. So what is a share? So your first question you have to ask is, do your company have share capital? If not, then share is not relevant to your company. If it's a company limited by guarantee, then no one owns any shares in that company. But if your company do have share capital, then share basically represent your portion of the ownership of a company. Okay, so if a company only has 100 issued shares and you own 50, that means you own half the company. Okay, but if the company issued 1,000,000 shares and you own 50, you own less than 1%. So it's always relative to the total number of shares issued by the company. Now, share capital, as mentioned before, you have issued share capitals. Those are the capital that really has been allotted and issued to the different members. Paid up and unpaid capital. For some companies, it is permitted for some of the capitals not to be fully paid at the beginning. So let's say if you are a public company but not a listed company, it may be possible that you allow new investors to partly pay for the shares, but they become a member. In that case, the amount of money they paid is the paid up capital, and the amount they have not yet paid is called the unpaid capital. Okay, so in that context, if the directors feel, okay, we now need more money, more cash injection. Previously, all these people paid half of the capital. We now need the remaining half. So the amount called by the director, which means pay the remaining amount, is called a called up capital. If there's still some amount that is unpaid and uncalled, it's called uncalled capital. So it's informative to anyone looking at the information to know how much capital was issued, how much was paid up, how much was called, how much uncalled. And then the next one is allotment and issue of shares. So allotment is where the company allot shares to someone who wish to be a shareholder of the company or who wish to have more shares in the company. That's an allotment, okay? And then preemption rights. This is closely linked to allotment. So generally it would be the directors, the board of directors who would decide to allot shares, okay? So preemption rights usually would be stated in the articles. And what does preemption rights mean? It basically means that if I want to sell my shares, okay, I need to offer to the existing shareholders first. Okay, so that's the classic preemption rights. Is, let's say there are only 4 people who own shares in this company, and we want to make sure our business and our company remains within the 4 of us. So if one of us no longer want to own shares in the company or not want to own all the shares in the company, may wish to sell the shares to someone else. Now, if the shares is sold to an outsider, all of a sudden you have a 5th person, a stranger or outsider, who are now shareholders of the company. So preemption rights in that context would be any shareholder who holds shares in our company must offer those shares to existing shareholders first. Okay, so it's offered to them first. I no longer want to keep the shares. Do you want to buy it from me? And if they wish, they can say, yes, I will buy from you. Then no outsider can come in and be shareholders in the company. Alternatively, they receive the offer, but they do not have money or they don't want to buy. Then they'll say, no, I don't want it. Then the existing shareholder can sell the shares to someone else. So that's an example of a preemption rights. Now, it's possible to have a preemption rights on the allotment of shares from that context as well. So for example, the company is already formed. If the company want to allot more shares, it must ask the shareholders first. Okay? But the situation is not the same as existing shareholder, right? Why? Because even though in the legislation we call preemption right, it's not really offering to sell to them first. It's actually asking them for permission to allot more shares first. Now, of course, they may allot it to all the shareholders if they wish, but it's entirely possible they already have someone else in mind they want to allot. So that's why allotment of shares is slightly different, even though the term sometimes is used in both contexts. So it's actually stated in the ordinance that the directors cannot allot shares unless they have approval in advance from the shareholders. Okay, there are exceptions. For example, if the directors allot shares on a pari passu basis, what does that mean? That means it is based on the same proportion as the existing share ownership. For example, for every 10 shares you own, you can be allotted one more shares. In that case, if everyone gets the extra one shares, the percentage of ownership remain the same. That's the reason why in those situations, no need for approval in advance. However, if it is not based on the ownership proportion, you want to allot more shares to a particular investor, in that case, you need to get their approval. So the approval in advance, there are different forms. For example, it can be a general mandate, which means the shareholders permit the directors to allot more shares anytime it wants throughout the year. Okay, so the approval can only last for a maximum of 1 year until the next AGM. Okay, so that's number one. Second possibility is on a case-by-case situation. Each time you want to allot shares, you ask the shareholders for permission, and they only give you permission for that one time. As explained, that's the safer route and that's the more common route. Okay, so there can be a third one where they give you special conditions, meaning we give you the approval, but only if it meets these conditions can you go ahead and do the allotment. So there are different types. The second one, where is a case by case, is more common. Okay, then offering of shares, we have the IPO and prospectus. So if you are a public company and you want to be listed, it's very common you do what is called an initial public offering, IPO. In that case, is you will apply to the Hong Kong Exchange. You have all these requirements. If you satisfy them and they approve, then you can proceed with your IPO. And basically, you would invite the public to subscribe for your shares. Okay, and generally, you would actually either give a range or you give a maximum price in which the shares will be provided to the subscribers. Okay, so it may be $3.40 per share maximum. So the final price may be $3.20 or maybe $3.40. Sometimes it's a range, maybe between $3 and $4. So as long as the final price is between the range, it is okay. So there's actually a consultation by the Hong Kong Exchange at the moment asking whether it's possible that the final price can be maybe 10% higher than the maximum price stated in the prospectus. And we'll see what happens with that consultation. So as mentioned, if you decide to do a public offering, you must have a prospectus. So first of all, is in the CAP 32, there's a requirement of prospectus. So prospectus is a very important document. Because imagine you do an IPO, you're offering shares in your company to the general public, asking if they want to invest in your company. Now they have no idea about what is it your company about, what business you're in, how well or not well your company is doing, but they are investing money in your company. So that's why a prospectus must contain sufficient information so that the investors can make an informed decision whether to subscribe for your shares or not. So under CAP 32 and also in other ordinance as well, including the SFO, there are responsibilities and liabilities if you make a false statement in the prospectus. So first and foremost, of course, is the directors. because they are the one who will be involved in preparing and approving the prospectus and other documents. So if they know that there is false information, then they should promptly give notice, either stop the prospectus from being published, but if it's published already, they need to take steps to inform the public about the problem. Okay. Then moving on to classes of shares. So we've talked about this before. Most companies have ordinary shares, but it's entirely possible they have other type of shares as well. Maybe A shares, maybe preference shares, that's entirely possible. Variation of class rights is if you decide to make some changes, like you want to amend your articles, and the change would affect the rights of a particular class of shareholders, then you need the approval as well. Then there's a difference between transfer and transmission of shares. So if I own shares, I'm an existing shareholder and I want to sell my shares to you, you pay me money, I give you the shares, that's known as a transfer of shares, okay? Whereas transmission of shares, sometimes it would happen by law or by a particular event. So for example, if someone passed away and the shares is now passed on through the estate to the beneficiary or to the person who inherits the shares, that would be known as transmission of shares because it's not actually a buy-sell exchange sort of situation. Okay, so let's look at some questions from the past exam paper, starting with question 3 of the November 2023 exam. So here is asking, what are preemption rights? Explain why they're important for a company's existing shareholders when new shares are allotted. So I think I've explained already previously is if you are existing shareholders, you own a percentage of the shares in the company. So the percentage would affect the power of your voting. It will also affect how much dividends you receive. So imagine if the company allotted new shares, many new shares to someone else or to only some of the shareholders. Then most likely existing shareholders, their percentage of shareholding will be diluted, meaning the percentage will be lower. Okay, so rather than owning 10% of the company, maybe after allotting new shares to someone else, my percentage reduced to 8% or 5%. Okay, so that would not be in my interest, and that's the reason why you have preemption rights, is to protect your percentage. In some case, for private companies, is to ensure you are not taken by surprise and some outsider or stranger all of a sudden become a member of the company as well. So here, the examiner's comment is that while many candidates were able to correctly describe the concept of preemption rights and the importance, only a few refer to Section 160, which defines the conception of preemption rights in the case of transmission of shares. So you will recall in the previous slide I mentioned, you have a difference between transfer of shares and transmission of shares. Okay, so if you're able to answer the question based on transfer of shares, I think you've done very well. But if you also understand transmission is wonderful as well, your answer is more complete. So basically, transmission, I think, is talking about the articles. So if the articles stated there is a preemption right on transfer of shares only, then you cannot enforce a preemption right when it comes to transmission of shares. In other words, if the shareholders want preemption rights in both situations, then you need to state both of them in the articles, meaning the preemption rights will apply to transfer of shares and transmission of shares. Then the court will be more than willing to enforce that in the articles. Okay? Okay, then let's look at question 4 of the June 2023 exam. So many companies listed on the exchange are non-Hong Kong companies, the shares of which are required to have a nominal value. Explain what the nominal value is and what the nominal value means in terms of a shareholder's obligation. So according to the examiner's comments, most candidates correctly pointed out that the nominal value of a company is the par value attached to shares, and that this is not always the same as the market value of the shares. So this is an interesting question because it touches on a bit of history. In the past, previously, it is mandatory based on the company's ordinance that in your books and records, you must keep what is known as a par value. So for each share, you will say, the par value is $1 per share or $2 per share. So that's just an arbitrary nominal value. So in your records, in your financial statement, when you calculate the share capital, you will start with the par value. However, most likely that would not be the same amount as the market price, meaning the amount of money you paid for the shares. So that's why what happens if the amount paid is more than the par value? Well, you have what is known as the share premium account. So let's say the par value is $2 per share. Let's say the real market price when you sold the shares, it is $100 per share. Then your share premium account would contain $98 per share. So you can see it's an arbitrary value, but then you need to keep a separate account just so that you can reconcile with the actual amount. So that's the reason why they remove par value now, and you no longer need to keep it. You just basically use the price that was paid for the shares. Okay, let's now look at the capital maintenance rules. So we'll talk about the doctrine, talk about reduction of share capital. What is it about? So the doctrine of capital maintenance is where the company first is incorporated with some share capital. That means from the point of view of an outsider, let's say a creditor, lending money to the company or giving credit to the company, would believe there's still money in the company to repay them if needed. So for example, if you are a supplier and you sell goods to a company on credit, which means I deliver the goods to you today and you pay me by next month. That's a form of a credit because I'm giving you the goods already and you do not have to pay me immediately. Now, that's on the assumption that I believe there's still money in the company so that when needed, you can still repay me. So let's say if I look at the financial statements of the company, I can see a share capital of $1 million as an example. So if I sold you goods for 100,000, I think, I should get repaid if necessary. Now, what if the directors of the company decides to reduce the share capital? So what does that mean? Let's say initially there was $1 million of share capital. Now they want to reduce it to 500,000. Okay, so that would mean 500,000 is returned to the holder of those shares or owner of those shares, and the shares will be returned to the company and basically reduced. So in that case, if they keep reducing the capital and is no control over how much can be done or no process that's required, no approval that's required, then there's a risk that if the company cannot repay the creditors, there will be no resort for them because that's all the money left in the company. And based on a separate legal entity concept, as confirmed in the Salomon & Salomon case, they cannot go after the individual shareholders. Generally, they cannot because of a separate legal entity principle. So that's the reason why this is so important. And that's why we have certain sections in the company ordinance governing this. Okay, acquisition of own shares is where the company buy back its own shares, so that will be closely related. What do they do with the shares after they buy back? In most cases, they will have to cancel the shares. Financial assistance to acquire own shares. So normally, if I allot shares to investors who wants to become shareholders, they would invest their money into a company. That's fine. What if somehow the company lends money to the investor? The person used that money to buy shares in my company. There's something very wrong with that because that's the company financing someone to buy shares in the company. So in those situations, you can already guess it's out of the usual normal course of business. You will need, if it's a sizable amount, you need to have disclosure and you need to have proper approval. Distribution. So this is where the company distributes money back to the shareholders. So it's permitted because that's in the form of a dividend. But as part of the capital maintenance rule, can only do that out of distributable profits. Meaning every time the company makes a profit, make more money, the extra money can be used to pay back the shareholders as a return in the form of dividend. Nothing wrong with that. But if you did not make a profit and you still pay money back to the shareholders, that would amount to returning capital to the shareholders rather than distributing profits because you have no profit. So that will be contrary to the capital maintenance rule. Okay, so let's look at some questions from the past exam paper, starting with question 4. So question 4, it says, Section 236 of the Company Ordinance established a general rule that a company may acquire its own shares except under certain specified conditions. Explain the justification for a prohibition of share buyback set out under Section 236 subsection 3. So here, according to the examiner's comments, only a few candidates were able to provide relevant justifications. Most candidates simply discussed the procedure to buy back, which was not relevant to the question. So you can see here they're asking why. Why are there such restrictions? So I think now, after attending this workshop, you can easily tell them it's because of the doctrine of capital maintenance. Need to make sure that the company continues to have share capital so that if necessary can have money to repay the creditors. Okay, that's the main reason. Of course, you also have the situation where you need to look at if they're acquiring the shares using, for example, financial assistance. That's something mentioned before. But you're saying explain the justification for prohibition on share buybacks set out in section 2363. So as mentioned in the earlier slide, if the company buybacks the share, it will have to cancel the shares. So after canceling the shares, the share capital will be reduced. So that's the reason why, because if you have a reduction of share capital and you end up with a situation where there's not enough money to repay the creditors, then that will be unfair to them. So I think that is in line with the doctrine of capital maintenance. Okay, so explain how a company reduces share capital. So doctrine of capital maintenance is to protect the creditors. So you must satisfy the criteria before you can reduce share capital. It's not saying you're not permitted to do so. Okay, you're allowed to do so as long as you maintain your capital and then you can repay your creditors. So in this particular question, it's asking you how. Okay, so if it's permitted, so how can you reduce the share capital? So here the comments say most candidates demonstrate an understanding of relevant concepts. So it's good. It means in that year, most candidates answered this question well. So there's basically two methods or two routes you can go about to reduce your share capital. Method number 1 is you need to have a special resolution. That is, you pass a special resolution, 75% or more in votes to reduce the share capital, and then you receive court confirmation. That's number 1, okay? That's using the court's system, asking the court to approve your reduction in share capital. Second method is known as the court-free procedure, meaning you do not go through the courts. How would you do that? Is again, you need a special resolution, but then you need a solvency statement. Okay, what is a solvency statement? Well, it's a statement that needs to be made by declaration by all of the directors on the board. Okay, each of them needs to carry out an investigation and then declare that the company is able to repay its debts as they fall due in the coming 12 months. That's basically what they need to declare. Each of them will need to do that, and each of them will need to sign on the solvency statement. Okay, so in most cases, you have the voting by the board of directors, but each of them do not have to sign anything. Okay, however, when it comes to something as important as a solvency statement, which for example is used for this purpose, reduction of capital, each of them will have to sign. Okay, so they cannot make a false declaration, otherwise it will be negligence and they need to do their role. And the directors are in the best position to know how well or not well the company is doing. So they basically do not have excuse to say, oh, I thought the company was doing well. No, you actually do have access to the information. You will need to check before you sign, saying the company is solvent, able to pay their debts as they fall due in the coming 12 months. Okay, so either method is the way to go if you want to reduce the capital. Okay, let's continue. Corporate transparency. So we have, loan capital. So we have the power to borrow. That is whether you are permitted to borrow. So it goes with the power granted to the board. If it's permitted to borrow, sometimes some articles will say there's a limit. They can only borrow up to 1 million, and if they borrow more, then they need to seek shareholders' approval. So always need to go back to the articles. Types of security. So there are many different types of security. So the most common one, of course, is if your business owns some assets, like a property, then you may grant a charge over the property to the lender. Okay, so that if there's a chance you default on your loan, you cannot repay your loan as they fall due, they can turn to the security, sell to the secured asset, sell the property, and use the money to repay the debt owed to them. So there's a different types of security, but of course, charges, there are fixed charge and floating charges. Fixed charge is where you already know which specific asset is used as security for the loan. For example, a charge over the property owned by the company. That's a common example, okay? Now, for fixed charge, in most cases, you cannot deal with the asset while it's under charge, okay? Generally speaking, you cannot, okay? But floating charge is different. Floating charge floats over a class of asset rather than a specific asset. So what does that mean? For example, if it's floating charge over the inventories, the stocks of a company, then it's not a charge over a specific item of inventory. You're still carrying on business, you can still continue to buy more inventories, and as part of your business, you can still continue to sell your inventories. So the exact item of inventories you have on hand on the date you granted the floating charge most likely will not be the same 1 month later or 1 year later. Okay, so floating charge is not over a specific item of asset, it's normally over a class of asset. Maybe over your inventories, maybe over your accounts receivable, and as part of your business, the course of your business, those items will change over time. You will buy more inventories, you sell more inventories, you will produce more inventories if you're a manufacturer, and you will of course sell more inventories. Okay, so does that remain that way the whole time? It does until the floating charge crystallize. Okay, what does it mean by crystallization? It means it hardens over those specific assets. So when you first granted the floating charge, it hovers over the class of assets. We have a claim on that class of asset. You can still deal with it, you can still buy more inventories, you can still sell your inventories. However, if, for example, there's a breach on a clause in the loan agreement, which causes, for example, automatically crystallization, in that case, the floating charge will harden over the specific assets that you hold in that class at that particular point in time. Then you cannot buy or sell those assets anymore. They are now governed by the floating charge. And then if you're not able to repay your loan or the credit that fall due, then the lender will have a right, basically get a receiver to come and take control over those assets, if necessary to sell them and use the cash to repay their debts. If there's anything extra, anything remaining, they will give it back to the owner. Okay. Now, determining the type of charge. So you can see on the list, you have fixed charge and floating charge. So clearly you can see they operate in different ways. Generally speaking, there are more flexibility on floating charge compared to fixed charge. So when you determine the type of charge, of course, the outcome would also be different. However, the courts have clearly stated on multiple occasions, labels alone would not be sufficient. For example, if on the document I say I have granted a fixed charge to the lender, that's just a starting point. That's not the end of the story. If there's a dispute and the court sees that in substance, in the conduct and circumstances, it really is not a fixed charge that was granted to the other party, it's entirely possible for the court to decide it's not a fixed charge, so you do not get the treatment of a fixed charge. Okay, so what's the treatment? Well, basically, if there's a time of insolvency and liquidation, fixed charge will have higher priority than a floating charge. So that's why it's important, if you are granted a fixed charge as a lender, if there's a dispute, you want the court to recognize you do have a fixed charge so that you get higher priority. If a company is insolvent, meaning not enough money to repay the debts as they fall due, then priority matters. The earlier you are in the ranking, the earlier you get paid, the higher the chance you get some money back. Okay, imagine there's not enough money to repay all the debts falling due. Then definitely the higher in priority, the better you are. Okay, the higher chance you get something back. So in the case decided, they say, even though on paper you say you granted a fixed charge, but it turns out in reality you're allowed to deal with the assets as you wish. You can buy more inventories, you can sell more inventories, the money on the account, you can use it as you wish. In that case, it's not really in substance a fixed charge, it was just a false label. In that case, it's entirely possible to be treated as a floating charge and the priority will be lower. Okay, now we move now to the next one is registration of charges. So registration is a requirement under the Ordinance Cap 622. It's very important because how would you know who comes first? Since I said priority is important, how do I know, for example, the company granted a charge to me first before granting to you? That's why registration is important. So based on the ordinance, you need to register within 1 month from the date of creation of the charge. If it's not registered by the 1 month, then the liquidator can basically ignore your charge and put you in a lower priority. So if you have a fixed charge or you have a floating charge, it's in your interest definitely to have it registered, especially if a fixed charge have a higher priority, you want to make sure it's properly registered. Okay, so let's look at the different questions. There are similar questions, so I will just go through question 5. What is the main difference between a fixed charge and floating charge? So I've briefly gone through it before, but I think it's helpful to look at the comments from examiners again. So it's that candidates expected to explain that a fixed charge is a charge taken over a specific asset of the company, such as a building or a piece of equipment, while floating charge is taken over a class of asset, present or future. So a company that can grant a fixed charge will be unable to sell or deal with the charge asset unless it first repays the charge holder or obtain consent. While a company that grants a floating charge will usually be free to deal with the charge asset until the charge crystallizes. So using the example before, if I have a floating charge over my inventories or my accounts receivable, definitely as part of your business, the amount of inventories and accounts receivable will go up and down based on your business. Okay, but a fixed charge, not the same. Unless you have consent from the charge holder, you cannot deal with the asset, cannot buy more, cannot sell. So continuing with the comments from examiner, however, only a few candidates made reference to the fact that certain floating charges are vulnerable to be set aside by the liquidator under section 267 of Cap 32. So these are known as the countermeasures. What are they? So let me just give you a brief explanation. If a company is in financial trouble and is gone into liquidation, a liquidator would be appointed to come and take over the company, basically take over the control and management of the company. In that case, the liquidator would review some of the transaction that has occurred before liquidation, and if it finds any transaction problematic, he may use the sections in the ordinance and challenge them, and if successful, those transactions will be overturned. If they're overturned, it's possible that some money will come back to the company so that more money will be available to repay the creditors. That's basically the countermeasures. Now, Section 267 is one of those countermeasures. There are others as well, and I'm sure you'll see them in your study materials, okay? So 267 only deals with floating charge. There are other countermeasures dealing with fixed charge, but for floating charge, only 267. Okay, so 267 basically asks, did you have these transactions during those period of time? For example, over the past 2 years or 1 year or 6 months, depending if it's with a connected party or not. And most importantly is in those situations, when you granted the charge to the other party, did you have new money? Did new money come in as part of your commercial transaction? If yes, it is possible you can avoid the consequence of 267. If not, then the floating charge will be invalidated, meaning they can basically cancel the floating charge, and then of course the lender will not get the benefit of the floating charge, meaning get the money under those charges. Okay, let's now move on to question 5. It's a similar question but slightly different. Describe 3 key characteristics of a floating charge and explain why a creditor may prefer to take a floating charge rather than a fixed charge over the company's assets. So here you can see here is stated in the Re Yorkshire WooCommerce case, how would I classify a charge as a floating charge? So it said if it's a charge over a class of assets. So remember, maybe it's a charge over the inventories or class over the accounts receivables. Those are classes of assets. And then the assets can change in the ordinary course of business. So just like inventories, you can buy more inventories, you can sell inventories as part of your assets. And then you can basically deal with them until the charge crystallizes. So for example, if you breach one of the clauses in the loan agreement may trigger crystallization of the clause, then you can no longer do so. So why? Why would a lot of business prefer to grant floating charge rather than fixed charge? You can understand it's because they can deal with the asset. Otherwise, if they have a fixed charge over the inventories, they are not allowed to buy or sell the inventories unless they get permission each time, then that would not be workable for them to run their business. So some candidates spend time talking about control. So if there's more control over the asset, is a higher chance it's a fixed charge. But of course, that's not the main focus of the question, so we need to be careful about that. And then advantages and disadvantages of floating charge. Be careful going on too much beyond the question because it's only a 5-mark question. Okay, then moving on to the next one, corporate transparency. So we have our statutory registers. So we have previously talked about the register of members. There's also register of directors and company secretaries, so anyone can clearly see who are these people who take up the official position. But there's also a register of charges. So that's relevant to what we discussed in the previous slides. If I want to find out about the company, I would want to know whether it has already granted charge over any of its assets to, for example, a lender. Okay, so the more charges granted, of course, then the investor need to worry because does that mean all the assets already under charge? And does that mean the company borrowed a lot of money? Is it higher risk? So that's why these statutory registers are very important. So statutory registers means it's required by the law. So based on the company's ordinance, they must keep this register. And as mentioned before, now they also need to keep the SCR, the Significant Controller Register, for AML CTF's purposes. Then we have annual accounts and reports. So as briefly mentioned before, is each year the company must produce financial statements, basically to let the shareholders know how well or not well it has done throughout this year. So it will include, of course, the financial statement showing the financial position. So how well the company is doing, for example, how much assets it have and how much liabilities it have. Hopefully the assets are more than liabilities. Then it will also have the financial performance, so how profitable the company has been. You compare the revenue of a company minus all the costs and expenses, and hopefully you get a positive figure, so it's profits. So you recall I mentioned earlier, is the company makes more profit, that would amount to part of the distributable profits because it's earning more money based on the money invested by the shareholders. And then there are other reports, of course, there's the director's report where the directors will report to shareholders how well they have done. And of course, most important, you also have the auditor's report. So because it's a requirement under company's ordinance, unless you're exempt, you must have your financial statements audited. So that's why the auditors plays an important role. For appointment, as I mentioned earlier, in the AGM, usually you would appoint in the coming year who will be the auditors. so that they can perform the work. They have the duty basically to ensure that the financial statements shows a true and fair view of the financial performance and financial position of a company. They need to make sure that the company complies with the requirements in the company's ordinance. So it's stated in CAP 622 some of the information that must be provided in the annual accounts. Sometimes it's a requirement if you're a group company to produce consolidated accounts. It also need to express a statement whether the accounting records agree with the financial statement, because the financial statement is basically a summary of all the accounting records throughout the year, so that is important. Then you, of course, in addition to doing that, they also need to show that the financial statement have been prepared in accordance to the accounting standards. So all those are requirements in the company's ordinance. Now, the duties and rights, of course, the auditors, they must carry out their role properly. They must perform investigation to ensure that they can obtain enough information to express those opinions, their views on the auditor's report. So they do have rights. Rights as in the company must cooperate and provide information as required to the auditors. And the auditors do have liability because if they were negligent, they did not perform the role properly, then obviously they must have situation where they're accountable. There's also resignation and removal of auditors. So this is similar to directors. One is voluntary and one is involuntary, basically. So resignation is where for various reasons the auditors no longer want to take up the role of auditors, whereas removal, it is the company wishing to remove the auditors. So again, removal is more serious, I believe. So that's why they have all these procedures in place to protect the interests of the shareholders as a whole. So that's why you must, in the notice, when you call to say you want to propose a resolution to remove an auditor, the information must be clearly stated in the circular so the shareholders will know it's an important meeting so that they would attend if they want to. The auditors must be given a copy of the circular, and then they must have a right basically to give a statement or to speak, to attend and speak at the AGM and be heard. So that's very important as well, because they do not want the directors to switch off the microphone or somehow make the auditors not able to speak to the shareholders. So the shareholders at least get both sides of the story so they can decide whether to vote yes or no to the proposal to remove the auditors. Okay, so explain the key duties of the statutory auditors. So here you can, as I mentioned earlier, but it's clearly stated in the ordinance, the key duties. So you can see is Section 407 of the company's ordinance, which clearly stated all the things they must do. As I mentioned before, they must investigate in order to form their opinion. So forming the opinion, they need to have done the work, the audit work to investigate the information to decide whether the answer is yes or no, whether it's true and fair view or not. And they must make sure there's adequate accounting records. So if they do not investigate, they will not know. So they need to go check and do their own tests and basically whether it complies with the company's ordinance and accounting standards. So all that is required. So you can see it's very important role they play in order to help the shareholders know that the financial statements are true and fair. So Kenneth explained the concept of special relationship, which was not directly relevant. So always be very careful because the question is quite clear. Explain the key legal duties of a company statutory auditor. So you can see the main thing they need to do under the ordinance is express the audit opinion, and then they need to carry out investigation and all that. However, the matter of special relationship is whether you can claim against the auditor. So this is on a separate, slightly related topic, but it's not the same as what the question is asking, because he is talking about key legal duties. So if you want to claim against the auditor, let's say if you are the shareholder, then the auditor clearly owes you a duty of care because their role is to audit the financial statement to let the shareholders know whether it gives a true and fair view of the financial performance and position. But let's say if you're not a shareholder, let's say you're an investor or potential investor, then is it possible that you actually have a right to claim against an auditor. So that's why the question of special relationship comes up. Okay, whether there was one or not, and if there wasn't, where there wasn't an assumption of responsibility by auditor, they do not even know you exist and they do not know they're overdue to you, obviously you cannot claim against the auditor. Okay, so that's even though it's indirectly related, but you have to be careful. It's a 5-mark question. So I think I emphasized this number of times, but I think that's helpful guidance. The number of marks is useful to let you know how much you need to write, how much time you spend on answering the question, and how far you go in your discussion. Do you branch off to something maybe indirectly related, maybe some indirect information, so like icing on the cake or a bit more information? If it's only 5 marks, I probably would not spend too much time on that. Okay. Okay, let's continue now to the next part. Market abuse or market misconduct. So that's cover many things, including market manipulation and all that. But one part that you can see a lot of in your study materials is insider dealing. Okay, so this deals with listed companies. Okay, it's included in the listing rules and it's also included in the Securities and Futures Ordinance (SFO). Okay. So you will need to be clear on the following. What is inside information? What are the offenses, possible defenses, and possible penalties? Okay. So if you have some inside information that is not generally known by the public, but if known by the public, it would affect the price of the shares in a material way. That would be the definition of inside information. Okay, so you can see it's clearly defined in the SFO. So it must be about the company or its subsidiaries or associate company. It must be or is about the officer of the company, maybe the director or shareholders, or maybe about the shares itself. Okay, any one of those which fits those categories I mentioned before will be defined as inside information. So here's some examples. Okay, so for example, if the CEO of the company is very famous and people believe it's because of the CEO the company is so successful. Let's say you have inside information that you know the CEO, because of illness or whatever, will retire next month. Now that's big news. Once that information is released, it's possible the share price could change a lot over a short period of time. So if before the public knew, but somehow you have obtained that inside information, then yes, it is possible that you'll be guilty of insider dealing. Okay, so of course, the next thing you need to define under the offense is whether you are a connected person or whether you received the information from a connected person. So normally that's one of the two possible ways you can obtain inside information about a listed company. So if you're a connected person, for example, if you're a director of a company, you're a company secretary of a company, you're clearly a connected person. If you receive that inside information and you dealt in the securities, or you counsel or procure other people to deal in the securities, that is insider dealing. Okay, that will be one of the offense. Okay, alternatively, you knew someone who was a connected person. For example, your friend is managing director of a listed company, and he or she obtained the inside information and somehow disclosed to you. So the act of disclosing that inside information to you, that managing director already committed insider dealing. Okay, insider dealing do not have to require you buying or selling shares. You, as a connected person, releasing inside information to someone else who may buy their shares, already insider dealing. But looking on from the other side, you're not a connected person, you received inside information from a connected person and you dealt in the shares or you procure or counsel someone else to buy the shares, also insider dealing. So you can see different parties involved would already possibly have committed an offense of insider dealing. Okay, so there are some defenses. The common general defense, of course, is what if you are a director of a listed company and you purchase shares as part of a qualification shares. So for some companies and some type of listed companies, you need to buy shares before you become a board member. okay, to show you have a stake in the company, so that when you make decision, you do it in the interest of all the shareholders, including yourself. So if you purchase shares because of that, that will be a possible general defense, okay? But of course, you need to be aware there are also blackout periods for directors of a listed company to buy shares before announcement. And nowadays, under the CG code, they also need permission from the chairman or the designated director, okay? So assuming you don't have defense, valid defense, and assuming you've committed a breach, then possible penalties. So there are many different types. If you face the market misconduct tribunal, you may be found guilty of insider dealing. Then they may hand down a number of orders against you, including the disqualification order I mentioned just then, where you can no longer be a director of a listed company for a certain period of time. Can be some cost orders against you for the cost of the government, cost of the SFC or the AFRC, and also a disgorgement order where you have to pay back all the profit you made from the insider dealing. So you see many bad consequences if you are found guilty of insider dealing. Okay, so let's look at some questions from past exam papers. So we have one from November 2023, question 4. So here is that insider dealing can adversely affect the operation of stock exchanges. Explain what inside information is in relation to insider dealing in the SFO CAP 571. So we covered this before, and that is, if you see this type of information, you need to know what is inside information before you can decide if someone has been guilty of an offense under the SFO for insider dealing. So inside information, of course, is about the company or about officer of the company or about the securities. The information is not known generally to the public, but if known, it would materially affect the price of those shares. So that would be the general definition of inside information. And the good news is most candidates were able to provide the relevant definition of inside information. So you can see they all were successful and they score all or most of the points here. Okay, so let's take a look at question 4 again, but this time November 2021 exam. So in order to be guilty of insider dealing under the SFO, a person must have inside information. Explain what information amounts to inside information. So this is very similar to that previous question, but it's 2 years apart. Here, many candidates provided information on insider dealing instead of inside information, while others discuss the concept of connected person, which was not relevant to this question. So you can see in November 2021, they did not do well, but luckily in November 2023, they all did well. So I guess they looked at the examiner's comment in the past exam paper, so they did not make the same mistake. But always be very careful. Is the question asking you specifically about insider information? Then of course, you mainly focus on answering that. But of course, if the question is asking about insider dealing, then it's different. Okay, insider dealing will look at the relevant sections, which offense. In most cases, you will need to deal with the definition of whether it's a connected person or not, whether it was dealing or not, and whether it was inside information or not. So if it's asking you about the offense of insider dealing, you need to look at more components. When the question is only asking about inside information, then you will want your answer to focus more on that. Okay. Okay, let's now look at the next topic is corporate restructuring and takeovers. We have the scheme of arrangements and we have the takeovers and minority shareholders protection. So you will recall earlier I mentioned is a lot of time if a company is not doing well, it becomes insolvent, usually you may enter into a process of liquidation. Okay, sometimes voluntarily on its own accord where the shareholders pass a resolution, we will now liquidate the company, or it's done involuntarily, meaning the creditor may petition the court to wind up the company. That will be a court winding up process, okay? But sometimes it is possible, even if a company is in financial trouble, not yet to liquidate a company. And sometimes you see a scheme of arrangement where there is a situation where you enter into negotiations with the creditors, see if it is possible to refinance some of the loans, whether it's possible to have some settlement, maybe a haircut, where only you need to make a partial repayment in order to settle the loan. Many different discussion, and most important, you need the agreement by creditors. Okay, in that case, it is possible to come up with a scheme of arrangements which needs the court approval. In that case, it is possible for a company to trade out of its trouble and not have to go into liquidation. Then you have takeovers. Takeovers are, for example, if you have a listed company, then you would want to know, I think I might have mentioned this earlier, is if someone comes and offer a high price to buy some of the shares in the company in order to take control, then it is possible you may have an unfair situation. Those people they approach, holding the majority stake, will sell the shares at a high price. But the minority shareholders do not get the same offer. They either cannot sell the shares or they will be forced to sell the shares at a low price. So that would not be fair. So that's the reason why, one of the reasons why they have the takeovers code, which basically have a threshold. And that is if you basically acquire 30% of the shares in a company, then it's mandatory you make a general offer. Okay, it's known as a mandatory offer or a general offer, which means that you must offer the same terms to all of the shareholders. Okay, so that's only fair. So if I pay a premium to buy shares from some of the shareholders, the same offer must be extended to the remaining shareholders so that they can sell the shares at that price if they wish to. Okay. Okay, so a scheme of arrangement. Let's look at question 5 of November 2023 exam. So a scheme of arrangement is one of the main rescue procedures for a company that is struggling financially. Explain the procedures for approving the scheme. So here, many of the candidates correctly pointed out that a special resolution is needed to approve a scheme of arrangement. So that's good. They all did very well in that part. However, only a few refer to the headcount requirement in the case of an arrangement and the concept of a negative 10% in the case of a general offer. So you can see here is they're talking about the requirement special resolution, as you recall, is 75% or more. But then they need to have looked at section 670, which talks about the situation of the head counting and the concept of a negative 10% test. So not more than you cannot have 10% of people saying no. Basically, it's a protection to the creditors in that case if you have a general offer. So I guess, as I said, if you look at a question, you're not 100% clear how to answer it. Since only a 5-mark question, just write down what you know. Okay, if you only know about the special resolution to approve a scheme arrangement, wonderful. If you do not know the remaining part, move on to the next question. Okay, it's only worth 5 marks. If you cannot get all 5 marks, maybe you get 2 or 3 marks, already very good for exam technique purposes. Because for exam technique, you just try to get the most marks possible, attempt as many questions as possible, hopefully attempt all questions, so that the chance of getting overall pass will be higher. Okay. Okay, then we move on to receivership. So receivership and duties of receiver. So for example, let's say you have a floating charge granted over some of your inventories, okay? And then there was a breach of a covenant of a term in your agreement. So there's a automatic crystallization. So it's entirely possible for the charge holder, the lender, to appoint a receiver to come in, seize those inventories, sell them if necessary, and use the money to repay the debt. If there's any money remaining, they will give it back to the company. So receiver, in a way, is similar to a liquidator, but it's not company-wide. It's basically over the assets in which the charge is granted over. Okay, now we move on to liquidation and dissolution. So it's interesting to note there are many different ways you can cease your business or close down or put your company on hold. So based on the company's ordinance, it is possible to do something called dormancy. Okay, what is dormancy? Dormancy is like putting your company to sleep and wake it up later when you need the company. So for example, I have a company, let's say a shelf company, that's a good example, okay? The professional firm, the company secretarial firm, they set up a company, but they will not use it for a while. and they want to save on compliance costs, so they make a special resolution, they pass a special resolution, and then the company is dormant. So what happens now? Well, the company just sits there, it doesn't do anything. And then someone comes along and say, I want to buy a shelf company from you. So in that case, it is possible to pass a resolution to put the company out of dormancy. And then if necessary, you need to do all the other compliance as well. So dormancy is one way to go. So it's not just for shelf company. It can be for your own company. You use it for business. Now you decide to stop your business for 1 or 2 years, then you may put your company in dormancy. It will save you on compliance costs. Okay. The second possibility is deregistration. So here is, I do not want something temporary. I want to close down my company because I will not be running my business anymore. In that case, the cheapest and the most simple way to do so is deregistration. You would apply through the prescribed form to the CR. Okay. And when you submit to the CR for deregistration, of course, there's some requirements you need to comply with. So for example, you will need to basically clear your balance sheet, make sure you sell all the assets and repay all your debts. But most important, you get clearance from the IRD, the Inland Revenue Department. Why? Because you're closing down your company, you're deregistering. So you want to make sure you've settled all of your debts, including the amount of tax you need to be paid. So that's the reason why you need the tax clearance from the IRD. You will submit a prescribed form to the Commissioner of Inland Revenue. And the IRD, once they receive your form, they will double check. Do you have any outstanding tax return? Okay. If so, they will send the return to you. You will complete the return with supporting document. They will issue a tax assessment to you if there's tax payable. Once you have paid all of your taxes, then most likely they will issue the tax clearance to you. So upon receiving the tax clearance, you can submit your form and other documents and payment to the CR, and then if everything goes smoothly, they can deregister a company. Okay, so that's the most basic and simple approach, and also the most common way of using it. Okay, however, it's possible that you may wish to enter into liquidation instead. Okay, so the remaining 3, members voluntary liquidation, creditors voluntary liquidation, and compulsory winding up, this is called winding up, all these are liquidation. And generally speaking, liquidation is more final. Okay, if I want to close down my company, end of matter, I don't want any matter coming up to me later on, 1 year later, 2 years later, liquidation is the way to go. It may take a bit more time, it may be more costly, well, at least you need to appoint a liquidator, but deregistration, not as final. Because based on the ordinance, there's a section which allows people to apply, for example, a creditor to apply to basically restore the company, reinstate the company, okay? Meaning wake it back up. So it's not as final as you might wish it to be. Of course, someone need to do that. If they do not, it remain deregistered. So if you want more finality, then liquidation is the way to go. Members voluntary liquidation, as the name suggests, is the members, the shareholders, they themselves want to liquidate the company. So they will pass a special resolution in general meeting and say, we will now wind up the company. Okay, so that's a possibility, and a lot of companies, if they want more finality, they will do that. Alternatively, you have what is known as a creditor's voluntary liquidation. So in that situation, is you did pass a resolution to wind up the company. However, you're not able to the board of directors are not able to issue a solvency statement. So we talked about solvency statement before, but now it's for a different purpose. Previously, it's for reduction of capital. Now it's for liquidation. So you can imagine, what is the definition of solvent or insolvent? When can you issue a solvency statement? Is if your company can settle their debts as they fall due in the coming 12 months. That's the basic definition under the ordinance, okay? So if the directors, they don't feel comfortable, it's uncertain, we owe so much money and we have so little cash, we may not be able to do that, then they may refuse to issue a solvency statement. In that case, then even if the members have passed a resolution in general's meeting to go into voluntary liquidation, then they must go to the creditors. And the creditors, of course, they will take over the situation. So you can see in an MVL, where you are able to issue a solvency statement, you say we have enough money to repay all the debts as they fall due. In other words, it's not the concern of the creditors. Because they all got their money back. What I do with my company now is not your business, okay, to put it in a colloquial way. However, if you do not have enough money to repay all your debts as they fall due, then the winding up of the company is concern to the creditors, okay? And based on the priority of repayment, the creditors should get repaid before any money goes to the members, to the shareholders. So that's the reason why if you do have a creditors voluntary liquidation, then they will have a lot more say. You have the creditors meeting, making decisions, including the appointment of liquidator. So under an MVL, members voluntary liquidation, it is the shareholders who would appoint the liquidator. But if you have a creditors voluntary liquidation, the creditors in the creditors meeting have a final say on who will be liquidator. Obviously, because now they have an interest in the liquidation of the company. Okay, so at least these are all the voluntary process, which means that either the members will deal with it or the members and the creditors will deal with it. Then we move on to the next category, which is compulsory winding up, which is also known as court winding up. So it is still liquidation, but this one, the court will be the one supervising the process and basically needs to report to the court. In that case, it's normally commenced by petition of a creditor. Can be one or more creditors petitioning for the court to wind up the company. Okay, it is possible for a member to ask to wind up the company. So for example, if the members pass a resolution, they may resolve that the company should be wound up by the courts. So it can be many different reasons, but a most common one is basically there's no one left, there's no one remaining, or they cannot come to an agreement, so that's why they rather have the court do it. So that's one possibility. But in most cases, creditors will do that, but it's also possible for the regulators to petition as well. So in that case, the court would see if any of the grounds under Section 177 is satisfied. For example, if they can prove the company is unable to pay its debt as it's fall due, that would be one of the valid grounds. It's actually one of the most common grounds, okay? The other one, as I mentioned before, is the just and equitable grounds. And if you can prove to a satisfaction of the court, and then it can grant the winding up order. So basically, you would petition to ask the court to wind up, but if the court agrees, it will hand down a winding up order, and then you will have the winding up. Okay, so in a court winding up, the liquidator will be appointed by the court. Okay, so that's one of the biggest difference as well. A role of the liquidator, as I mentioned earlier, the liquidator, once appointed, will go to the company, takes over the control and management of the company. So from then on, basically the directors no longer have powers to run the company. Now, the liquidator can decide to retain some of the liquidator, some of the directors to help run the company. So for example, the liquidator may not be familiar with the business of the company. And if some of the directors are familiar with the business, they know the customers, know the suppliers, it's possible that the director or directors remaining to help run the company will be helpful. Okay, so the liquidator would want to do things that is beneficial to the liquidation. Try to get as much assets as possible and to repay the creditors in an orderly manner, okay, based on the priority. So in that case, sometimes they may say, the CFO or the managing director, please stay on. You can continue to help manage the business for the benefit of the liquidation. Okay, then you see these four, these are the countermeasures I was talking about. Okay, so it's all from Cap 32. And these sections is where the liquidator can, if it sees necessary, to invoke the power to basically challenge some of the transactions that has taken place prior to liquidation. So you can understand is the liquidator was not in charge or involved with the company until he or she was appointed as liquidator of the liquidation of the company. Okay, so it's entirely possible the board of directors, they have entered into many transactions before liquidation. Some of the transactions are valid commercial transactions. The liquidator will not disturb them. Okay, but it's possible some of the transactions may have breached any one or more of these sections. then the liquidator would have the power to challenge them. And if the court agrees, it is possible to either invalidate the transaction, meaning cancel them, or somehow can adjust them if necessary by the court. So that's why these are very important sections for liquidation. So for example, extortionate credit transaction is where the company enter into a loan agreement or an agreement where they obtain credit, but the terms are so extortionate. It is so basically unfair, in a way unfair to the company. So it's too expensive. So imagine if it took out a loan and it's being charged 30%. Okay? On the surface, that would be too expensive because most commercial loan now is around 10 or 15%. So how can it be 30%? So that means more interest is being paid out than necessary. So it's possible for the liquidator to challenge it and maybe try to recoup some of those money back to the company. The second one is transaction at an undervalue. Okay? So again, the company owns assets. Assets can be turned into cash, can be sold to repay creditors. So if prior to liquidation, some of the assets were sold to someone else at an undervalue, that means at below value, that means some money has gone, disappeared, been taken out of the company, which cannot be used to repay creditors. So a very simple example. Let's say the company owns a property worth $10 million. Let's say the company sold the property to one of the directors for $5 million. In that case, the company will only get $5 million back for giving up $10 million in asset. So you can see there's less money available to repay the creditors, but that should not have happened. So that would be an example how that transaction can be challenged. Unfair preference, okay? So that's to deal with, for example, an arrangement or transaction has been entered into before liquidation, and it provided an unfair preference to a particular party. Then, of course, the liquidator can challenge the transaction and may even ask the court to cancel the transaction. So let's say the company owes money to many suppliers, to many creditors, okay? But one of the suppliers is connected with one of the directors. Maybe it's a family member, maybe it's a relative, maybe it's a friend, okay? So the directors may decide, we will settle your amount first, okay? Instead of following the priority that the liquidator will use, they will just settle someone because they are friends, their family, their relatives. That, of course, would not be right. And if the liquidator saw that happen, can use Section 266 to challenge the transaction, and it's entirely possible to say no, that amount of money must come back to the company. Okay? And 267, we have looked at that earlier in the earlier questions, is about floating charges. Okay? So let's say if you are a supplier to the company, okay, usually you would be an unsecured creditor. If you're unsecured creditor, that means in terms of priority, you rank very low. Other people, other creditors will be repaid before you. For example, secured creditors will be repaid before you. And even when it is your turn, you'll be repaid pari passu to the other unsecured creditors of the same ranking. Okay? So in most cases, you will get little money or no money at all. So let's say the director, again, you are the friend or family or relatives of the director and decide to grant a floating charge to you instead, so that when it comes to liquidation, you get paid earlier than the other unsecured creditors because you now become a secured creditor. If the liquidator sees such a situation, then may use Section 267, which may invalidate the floating charge. So you, as the supplier, will return to being a secured creditor, and you basically do not get any advantage. Okay, so you can see the reasons for these countermeasures or these sections, because it's to be fair and to make sure credits are repaid in an orderly manner based on the sections in the ordinance. Okay. Okay, so the final one is corporate rescue. So this is basically saying, is it possible to have some legislation to protect the company so the creditors will not chase down the company and give the company a chance, I guess, to restructure and also to trade out of its difficulties. So we do not have these legislation in Hong Kong yet. There's been talks about it for many years, and there were a bill proposed about it a few years ago. So I know many people in the profession are still negotiating and discussing about this and promoting about this, and maybe one day we will have the legislation for that, for corporate rescue. Okay, so we have now finished covering all the different learning outcomes. So hopefully you can see there are a lot of topics involved, and that's why at the beginning it is recommended that you do spend time to cover all those topics. So they wrote 200 hours. Of course, it's up to you. Some people may need less than 200 hours. Some people may need more. But I think by starting early, by setting a particular day, at least 1 or 2 days, Saturday and or Sunday, maybe half day or full day, up to you, then at least you can steadily cover many topics. Okay? The more topics you cover, the more confident you become. Because then no matter which topic the examiner decides to examine, you are comfortable. You do not need to get full marks, as you know. So that's why if you're comfortable with many of the topics, then when you see a topic, see a particular question, you can make a good attempt. There's no need to get full marks, just try your best. For example, in section A, some of the questions you can answer very well, you can get 4 or 5 marks. Some questions you can't answer as well, but you still try to write something, maybe you get 1, 2, or 3 marks. You add them all up together, already comfortable. Okay, so that would be my suggestion. So now let's look at the exam format. I'm sure you're all familiar with it, but we can just take a quick look here. There's section A and section B of the paper. Okay, all the examples we have used so far for the purpose of illustrating different topics for the learning outcomes, I've extracted from the short questions in section A, because I think it's more effective and efficient if we use the short question to demonstrate different topics. Obviously, I don't think all the topics have been examined in the past exam paper, so that's why you saw I only use short question from past year's paper for some of the topics, because that's all I can find, but it's okay. This is just for illustration. I'm sure when you look at the study materials, they have very good explanation, and some will have examples as well. Okay, it's interesting to note 3 hours and 15 minutes reading time. So reading times are important and also helpful, particularly if some candidates they have a habit of reading a question too fast and then not reading it carefully and rushing to answer. The reading time is helpful because you're not allowed to write your answer during reading time. You might as well use it to read it carefully. So what I would do if I was sitting in exam with reading time, I would use it to read the question. Okay, that way if I read the question, I know the requirement, and then next to the question, I will just write 1 or 2 tiny points. This is about that topic, or it's about that topic. I may use highlighter and underline to key focus. This question is mainly asking about inside information rather than asking about inside dealing, which of course would be broader. Okay. For the longer question in section B, I would actually write down next to the question how much time to spend. For example, when I should stop. And I would definitely stop when the time tells me to, so that I can manage my time properly and attempt more questions. Okay, so be aware, short question you need to answer 5 out of 5. However, for section B, you only need to answer 3 out of 4. So make sure you read the instructions each year when you sit the exam, just in case they change. But if it remains the same, then you answer 3 out of 4. I have heard some students have answered 4 questions in section B. Now you can understand, if you answer 4 questions, you will not get marks for 4 questions. You only get marks for 3 questions. Based on my understanding, the best practice for professional exam marking is they will only mark your first 3 questions. The 4th one, they will not even read, they will not mark. So some students will think, if I answer all 4, will they give me marks for the best 3? My understanding is most professional practice would not do that. Professional practice is you mark only the first 3 and you will not even read number 4. Okay, so please only answer 3 out of 4. You will not gain anything from answering all 4. So the remaining time, of course, should be used to answer the 5 short questions in section A. Okay, but the time, of course, you allocate each question in section A is only 5 marks, so you only allocate a very short amount of time, okay, maybe around 8 minutes per question, okay. However, for longer question, it's 25 marks each. So in that case, obviously you will spend a bit more time, but just remember, you still need to answer 3 of the question in section B, so do not spend 2 hours answering one of the question in section B. So these are the, for reference, the time you should spend. So you can see the time you should allocate to answer one of the questions in section B would be the time you would spend to answer all the questions in section A. Okay, so that should give you useful information. If you find you're spending more time answering section A than one question in section B, then it's possible you're using too much time in section A. So be careful. It's 5-mark question, brief answer, move on, okay? So of course, once you've done this, if you've done it within the allocated time, by the end of the exam, you have already attempted every single question that you need to answer, meaning all 5 questions in section A and 3 or 4 in section B, the chance of passing is much higher. Okay, I have seen some students, they spend so much time on a particular question in section B, they ran out of time, could not answer 3 questions in section B, or could not answer all 5 questions in section A. The chance of passing, of course, will not be as high. Okay, so what I would now do is take a look at the general comments from one of the past exam papers. So it's November 2023. So here you can see the examiner is quite helpful because the general performance candidates was relatively satisfactory. So I look at different past exam paper, different exam diets, I should say. This description is not the same. Sometimes it's satisfactory, sometimes it's relatively satisfactory. So you can see the performance do go up and go down. And then the examiner do try to inform the candidates which areas they've done well and which areas they need to do better. So here they say some candidates still demonstrate a weak answering technique, particularly in the short question in section A. Many candidates fail to answer the question correctly or provide irrelevant information. So you can see some of the examiner's comments we saw in some of the short questions that we have gone through so far. The examiner has said exactly the same thing. Okay, they did not read the question carefully. They discussed many other things, additional information that's actually not asked by the question. So if they did that, number one, they will not get more marks for those extra information, unlikely to get many more. But more importantly is they end up wasting a lot of their valuable time writing on methods which do not score marks, which they can use to answer other questions. So be careful with that. So that's why candidates are reminded to read the questions carefully and to ensure the answers are relevant to the question. So it goes to say, with the reading time, just use it to read the questions. I think that's helpful. Okay, some people say, I'll start reading the story. Yes, that's one way you could do. But alternatively, since it is so common for many candidates to misread the question, it doesn't hurt to use the 15 minutes to read all the relevant questions. So for example, section B, you need to choose 3 out of 4 questions to answer. So how can you choose which one to answer? Obviously, you will need to read the question for all 4 questions and decide which 3 you're most confident in answering. So I think using the reading time to read the 4 questions will be helpful, and then briefly reading the questions in section A can be helpful as well. Okay, so in contrast, the major problem in section B was candidates' failure to correctly identify and address the relevant issues and rules. Many of the candidates simply described rules and cases that were unrelated to questions, such as providing information about the rules regarding a breach of director's duties, even though that was not applicable to questions. So this one have to be very careful. Because each question is worth 25 marks, you want to make sure you correctly identify what is the main issue this question is asking, and then which relevant legal rules would I use to answer that question. So obviously you can understand if you identify the wrong issue and you use the wrong legal rules, very hard for you to do well. But the cost is higher because it's 25 marks per question. So that's why more so for section B question, even more, you need to read the questions carefully and then just look at it objectively, calmly, and say, okay, what is this question asking about? I know this question about that topic, and for that topic, these are the main legal rules relevant to answering that question. Okay, so here is an interesting comment by the examiner, but I saw that in some of the past paper as well. Is some students, if they do not know the answer, they talk about director's duties. Okay, don't do that. Okay, in fact, I remember for 1 year, for 3 different questions, the examiner said the student talk about director's duties. Turns out only 1 question was asking about director's duties. So again, that means spending time writing about many things that is not answering the question. It will not score you more marks, but it costs you more time because you could have used that time to do other things that could score you more marks. So be careful of that. So finally, the candidates are reminded that they can only achieve good results if they correctly identify most of the relevant issues. That's important. So sometimes a question covers 1 issue, but for a 25-mark question, it's entirely possible to cover more than 1 issue. So just do your best. If you can identify, I'm confident it must cover issue number 1, go ahead and answer that. If you believe it covers issue number 2, go ahead and answer that. It may be possible there's an issue number 3, but you did not think of it. It is okay. Because at least you thought of 2 out of 3 issues, it is fine. Just do your best. It's not an exam condition. Okay? So candidates are also expected to demonstrate their analytical skills when answering questions, especially in section B. So you can see the questions in section B are not the same as section A. Section A are short questions worth 5 marks only. Section B are worth 25 marks each, so your approach will not be the same. Some students, the length of their Section A answer are longer than the answer to Section B. So I saw that with some of the mock exam in previous years. You can understand that's not good exam technique because you only get 5 marks for each question in short question, no matter how many pages you write. Conversely, if a question in section B is worth 25 marks and you only wrote 1 short paragraph, 3 or 4 lines, there's no way you can score even close to 25 marks. So your exam technique, your exam strategy definitely is how much you write depends on the marks allocated. Or I should say the time allocated for each question based on the marks allocated. Of course, quality is more important than quantity. So if what you write, it must be relevant to the question in order to score marks. Okay. So this is just from one of the past papers. You can see section A. These are the short questions, only 5 marks each. So definitely the time you allocate to each of them very short. You recall, you can see around 9 minutes per question, and the total section A only around 45 minutes. Conversely, section B, each one of them is 25 marks. You will spend probably around 45 minutes just for answering one of these questions in section B because they're longer questions. The story, you will need a bit more time to read, but it is okay. It's important you read the story carefully because these are the factual information you will use to answer the question. Okay? But of course, there is an exam technique in reading these stories, these case information, okay? You would want to avoid having to reread the whole thing again and again and again. That would take you too much time. So that's why you want to read it carefully the first time round. As you're reading, you will highlight some key terms. And also, as you read each paragraph, most likely you work out, I know which topic it's asking about. Write down that next to that paragraph. That would help you later on. When you come back to this page, you do not need to reread the whole thing again. If you're answering the question about a particular one, let's say here is about the articles, then you will only go back to this part and read and you can answer the question. Okay, so you can see here we have section B, we have Lily, May, and Rahul first began running a restaurant together in 2015. So here they decided to set up a company, and on the 15th of July, Lily ordered 20 tables from Summer Furniture. She signed a contract form on behalf of the company. And then on July 25th, Sunny received a certificate of incorporation, which was dated 20th of July 2022. So now, having read the first paragraph, I can already guess maybe this is about pre-incorporation contracts. Okay, so this is the helpful way as you're reading because you don't want to reread the story again and again. That's time consuming. So I would definitely highlight the date that Lily entered into the contract, okay? You can see on the 15th of July, she ordered the tables, she signed the contract, okay? But the company's certificate of incorporation was only on the 20th of July. So clearly this contract for the 20 tables was entered into before the company was properly incorporated. So that will be useful information. I will highlight the date. I would write down pre-incorporation contract. It's only 2 words. But in exam condition, you're under pressure, time pressure, you may be nervous. Hopefully you find that will be helpful. Then Sunny issued 1,000 ordinary shares at $1 each. So the company issued that. Lily and Rahul are the only directors. They hold 400 and 300 shares respectively. So that means Lily is a director and hold 400 shares. Rahul is a director and hold 300 shares. May hold the remaining 300. So you can see 400, 300, 300 adds up to 1,000. Only Lily and Rahul are directors. May is only a shareholder, not a director. Now, the model articles of association for private companies limited by shares. So this is the template model articles provided by company's ordinance. It's adopted by this company, but they added additional clauses, these clauses, okay? So you need to read them carefully. Rahul will continue to be a director until 2030, receive an annual bonus of 2% of company's profits as long as he remains a director of the company. So you can see this clause is for the benefit of Rahul. But most important, you will use a highlighter and highlight the word director, okay? This is something for him as a director of a company. So you recall I mentioned earlier, it's possible for one person to wear different hats, wear the role of a director when he's in a board meeting voting, and wear the head of a shareholder when they're voting in the shareholders in general meeting. Second one, on any resolution remove a director, the shares of a director being removed will carry 2 votes per share. So this is talking about a special situation. Remember, removal of directors is involuntary. You want to remove me, so we need to vote. So I will have 2 votes per share. It's a very special situation. Is it permitted? And in part 3, the third clause, directors may not, on behalf of the company, enter into a purchase agreement in excess of 100,000 without the approval of the members. So the third clause already tells me this seems like an internal regulation. This is something that governs how much the directors can approve in the contract. Turns out there's a monetary limit. This is the maximum. Okay? So if the board of directors, remember directors, plural means board of directors, they have the power and authority to approve contracts, to enter into contracts on behalf of the company. But this special internal regulation, this special internal rule is saying for contracts in excess of 100,000, you also need approval by members, by the shareholders in general meeting. So you can already guess, most likely these may be some of the topics examined. So this one, most likely about the indoor management rule. So if I was reading this, I would highlight the 100,000 approval of members, and next to it, I would write down indoor management rule. So why would I need to write it down? Because I'm under exam pressure. So I can think of it now, wonderful. But imagine you're answering the question, you're so busy, you're nervous. When it comes to answering that part of the question, you forgot. So that's why, just in case, I would write it down next to it so that I will remember, okay? So now, in August 2023, the board signed a contract to purchase 5 new coffee machines from Best Coffee, which cost $200,000 in total. So yes, I think we guessed correctly, okay? $200,000 more than $100,000. Okay, so clearly this is about indoor management rule. Lily and Rahul did not inform May before signing the contract. So you can see they need approval of members. Did they ask the members for approval? Based on the story, it looks like they did not do so. That's why the indoor management rule will be relevant for answering this part of the question. Okay, so Rahul is often away on holiday and he rarely attends board meeting. Lily and May are unhappy with Rahul and they're considering removing him from office. So you can see here, it is a removal of director situation. So you need to check what are the procedures, are they able to do that? Okay, so let's look at the questions. You can see Summer has not received any payment for the tables. Advise Lily who is liable for this payment. So clearly part A is about pre-incorporation contract. We'll see whether the person signing the contract is liable or the company is liable. Part B, advise Lily and May whether Rahul can be removed from office, which procedure should be followed. And third, whether advise may whether the contract between Sunny and Best Coffee is valid or not, because it did not follow the indoor management rule and did not follow the articles. So how would you answer legal questions? So there are many different ways, but this is the way I've been discussing a lot because I think it's a very simple method. So you can use this for reference, and if you find it helpful, maybe you can use this as a way to help you answer legal questions. So the IRAC method is IRAC, which means the issues, rules, application, and conclusion. So you will notice from the examiner's comment, it said for part B, one of the main problems is the students did not, or the candidates did not identify the relevant issue at hand. So this is something you would want to do at the beginning when you look at the question. The second thing mentioned in the examiner's comment is did not use the relevant rules. Okay? Once you correctly identify the legal issues, based on your revision, based on your study of the materials, you would know which sections of the ordinance or which court case is relevant for that issue. So that one you would be able to follow. Okay? Once you have the relevant rules, you would apply them to the factual situation. Okay, that's the story. You have a particular rule or a principle. You apply to story number one, you can get one answer, yes or no. But if you apply to a different story, different facts, you can get a different answer. So that's why application is important. So that's why in the examiner's comment, he said the analysis is very important and come up with a final conclusion. So let's look at the way you structure your answer. This is a suggestion. I think if anyone marking your answer will find it very easy to follow, but if you're comfortable, I think you use this as a guide or as a suggestion. So for the legal issue part, as I mentioned before, take your time. Even though you're in a rush, take 10 more seconds, read the question very carefully. What is it asking about? Is it asking only about inside information, or is it asking about insider dealing? Inside information, you'll focus on mainly on that criteria component, whereas insider dealing will look at inside information, connected person, whether it's dealing or not. So you can see the difference. That's why read the question carefully to see what is the main issue at stake. And then, of course, do not always conclude it's about director's duties, as explained by examiner. That's not always the issue. And if you use that all the time, it is possible you end up spending time where you may not get extra mark, but you end up getting less time to answer other questions. Rules, of course, as I mentioned, can be sections from the ordinance, can be principle of a court case. Here you can talk about, for example, relevant sections. Court case, you recall Solomon, you have the separate legal entity principle. Guilford, Moulton, and Horn, that's the one where you have the exception which overrides the separate legal principle where you can pierce the corporate veil if you are using the shell, using the company to evade your legal obligations. Okay, application. This is where you apply the principle to the relevant facts to arrive at your answer, and that this is very important. This shows you have good understanding of the factual information, good application, and good analysis, and explained by examiner that's something he or she wants to look at. And this is basically the final conclusion, final answer, whether the contract is liable or not, whether that person is breached of duty or not. That's just your final answer. Okay, so after so much explanation, I think it's helpful we look at a sample question. So go back to our same questions just then. We have part A, B, and C. Now we can see the examiner's comment. So these are the issues or the topics you want to look at in answering question 6. So you can see it's about pre-incorporation contract, removal of a director, enforcement of articles, and indoor management rule. So all that you will be able to work out from reading the story and or reading the question. Okay, I think it's helpful. That narrows down the scope for you so you know which area to discuss, which rule to use, which legal authority to use. Narrow down the focus of your answer so that you are writing only things that are relevant to answering the question, and you can score more marks and use your time well. So here the examiner said most candidates did well on the pre-incorporation contract part, but when it comes to the indoor management rule, they did not refer to section 117, so that's not as good. And only a handful of them talked about the weighted voting rights, that's having 2 votes per share if a director has been removed. So let's look at part A, pre-incorporation contract. So starting point would be the sections from the ordinance, company's ordinance. So section 122 subsection 1. So this section applies if a contract purports to have been made in the name or on behalf of a company before a company was incorporated. So section 122 will only apply if someone entered into a contract on behalf of a company not yet incorporated, not yet born. Okay? If that's not the case, section 122 do not apply. Okay? It's not relevant. Okay? Now, what does subsection 2 say? Subject to any express agreement to the contrary. So it's possible for you to have your own agreement. If not, the contract has effect as a contract entered into by the person purporting to act for the company, and the person is personally liable and is entitled to enforce the contract. So what is subsection 2 saying? It's saying whoever who enters into a contract on behalf of the company before it is formed, that person is personally liable. In other words, the individual who entered into a contract and signed the contract, it becomes a contract of that person with the other party. So if something goes wrong, that person is liable, personally liable. You cannot say, I did it on behalf of a company, the company is liable. No, because the company not yet incorporated. But at the same time, since it is my contract, I'm personally liable, I can also enforce the contract. Meaning it's a promise by both sides. I promise to do something, you promise to do something. If it turns out you did not do something like deliver the goods as promised, I can enforce the contract requiring you to deliver the goods as promised. However, subsection 3 is quite different to common law situation. Is the company may ratify the contract to the same extent as if the company had already been incorporated and then the agent was acting without the company's authority. So this is the part about ratification. Okay? Remember I told you ratification means the company say it is okay. We recognize the contract. We accept it as the company's contract. That's what ratification is about. So despite subsection 2, which says that the individual who entered into a contract on behalf of the company is personally liable and entitled to enforce the contract, if the company subsequently ratify the contract, then it becomes the company's contract. Okay, so it's important to understand subsection 1, 2, and 3. Now, application. Applying those rules to our situation. In this case, the company was incorporated on the 20th of July. Lily entered into a contract on the 15th of July. Therefore, it was a pre-incorporation contract under subsection 1 of section 122 of the company's ordinance. So you can see this is application, and that's why it's important to highlight those dates in the story, as I mentioned before. Okay, you can see entered a contract on the 15th of July, and the company was incorporated on the 20th of July. Okay, then apply subsection 2. Unless there was an agreement of contrary, unless you had an agreement with a company which says something else, otherwise subsection 2 would kick in. Lily would be personally liable for the contract that she signed unless SRL ratified the contract under subsection 3, which was not mentioned in the case. Okay, so you now know subsection 2. That would apply to the story. Unless the company has ratified the contract, then subsection 3 will kick in. Since no information about that, then most likely Lily will be personally liable for the contract. So that's finished with part A. Okay, so you can see very clear and very specific answer, only relevant to the question. Did not try to write more, did not write less. It's just enough to answer the question, score the points, and you move on to the next part. So next part, first of all, is about removal of directors. So you need to go to the company's ordinance and the articles. So in the company's ordinance, a company may, by ordinary resolution, pass a general meeting, remove a director. So if you want to remove a director, you call a general meeting, the shareholders will vote. You only need more than half of the vote to remove a director. However, there's an additional requirement, which is special notice, which means you must clearly state in your circular it is a meeting where you need a special resolution, where you need to remove a director, so that someone who have a view on this matter who understand it is a meeting, remove a director, will attend the meeting. Okay, that's important. And more important is, of course, the director must have a copy of the notice so he or she can attend the meeting to explain his or her side of the story. And then, of course, here is the resolution is no share may carry a greater number of votes than in a general meeting. So what it is saying is you cannot have a share that has more than one vote per share. That's basically what it is saying. Okay, so you understand this is in contradiction to the articles. Okay, so generally speaking, the ordinance would have more power than the articles. If it say it's not permitted and it does not give the power to articles, that would override the articles. Okay, then on receipt of the notice of resolution, the company must send a copy of the notice to the director. The director is entitled to be heard at the meeting so that it is possible for a director to tell the shareholders his or her side of the story. Now, if in giving you notice, the director can also give a written representation, but of course, it must be a reasonable length and satisfy the requirement, then that will be circulated to shareholders as well. And then here it is possible for the company to apply to the court and say, can we be exempt from the requirement allowing the director to issue a representation to the shareholders? So that is the case if you see the director was abusing the right and using it for needless publicity for defamatory matter, then the court may say, okay, no need to allow the director to do that. Okay, we now have all the relevant rules we can now apply to our situation. So in this case, Lily held 400 shares and May held 300 shares. That's 700 out of 1,000. So that's enough to pass an order resolution because all you need is a simple majority, more than 50%. Although the additional clause in the articles allow the directors to be removed to have 2 votes per share, Rahul will only have 1 vote because of section 462, subsection 7, and subsection 8. Okay, so that's why there is enough votes to pass the resolution. Okay, in other words, Lily and May together have 700 votes. That's enough to remove Rahul. He will only have 1 vote per share for his shares. Okay. However, you need to comply with the special notice requirement. Therefore, you must allow Rahul to know about it, to make written representation, and also to be heard at the meeting. And in this case, since Lily and May are also the shareholders, it's unlikely any representation by Rahul would change their mind. Okay, second part of Part B is about the enforcement of articles. Okay, so here you can see we mentioned this earlier. Is the articles is a statutory contract between the company and a member, and between one member and the other members. Okay, it's a covenant between each of them, and the articles may be enforced by the company against each member, and also by a member against a company and a member against other members. So they are the one who are contracting parties of the statutory contract. So therefore, only they, in their capacity as a company or a member, can enforce the articles. Okay, so that is important for our question, as illustrated in the case Ely and Positive Government case. So here the company's articles provide that Ely shall be the solicitor of the company and shall not be removed from office except for misconduct. Ely, who was also a member, sued the company for breach of contract, breach of the statutory contract for not employing him as solicitor. So the article, the court decided, did not form a contract between the company and Ely as a solicitor. So a person can wear different hats. Ely, in this case, he is a solicitor. He may also be a member of a company. But when he is enforcing a clause that is protecting him in his interest as a solicitor, he's not enforcing the clause in the capacity as a member. Therefore, he cannot do so. Okay. Also, in Hickman and Kent, the articles can neither constitute a contract between a company and an outsider, nor give any individual member special contractual rights beyond those of the members generally. So shareholders as a class can protect your rights and enforce the rights under the articles, but you cannot go beyond. So that's basically what Hickman and Kent is talking about. So applying those rules to our story, to our factual information. So although it was stated in the articles that Rahul will continue to be a director of the company until 2030, under Section 86(1), the articles have the effects of a contract between the company and each member. And under 86.2, only a member can enforce his rights under the articles. So as confirmed in Ely case, the contract created under Section 86 only relates to members of the company in the capacity of a member. Also confirmed in Hageman that it will not give any individual member special contractual rights beyond those of members generally. Therefore, Rahul would not be able to enforce his right in the articles to remain as a director of the company. Okay, so he's trying to enforce in his capacity as a director, which is not the same as enforcing in his capacity as a member. Okay, so we have finished part A and B. We can now look at the third one, part C. Whether the contract with Best Coffee was valid. So as I mentioned earlier, this most likely is talking about the indoor management rule. So we should first go to section 117 of Companies Ordinance. In subsection 1, it said, subject to 119, in favor of a person dealing with a company in good faith, the power of the company's directors to bind the company or authorize others to do so is to be regarded as free of any limitation under any relevant document of the company. Okay, so what is it talking about? It's talking about protecting outsiders. They have no idea what is going on, your internal regulation, what is done, what is approved, what is not approved. So as long as they are dealing with the company in good faith, under section 117 subsection 1, they can regard that the powers of the directors to bind the company in a contract, for example, is to be regarded as free of any limitation. Okay, and when I talk about relevant document, it would include the articles and other internal rules as well. So you clearly see in this case, it will apply to our situation. Now 2B talks about good faith. So it is normally presumed the outsider dealing with the company is presumed to be acting in good faith unless you have some evidence showing to the contrary. Okay, contrary is proof. That means if you have evidence to show it's not acting in good faith, then the condition under section 1171 would not be satisfied. But if there's nothing to the contrary, then you can presume that person is acting in good faith. And also a person dealing with a company is not required to inquire as to the limitation of power. So you cannot say, shouldn't you check? So section 117 is to protect the outsider. So unless there's some indicator showing something is wrong, something irregular, then they may need to check. Otherwise, they will deal with you in the normal course of business and they can act in good faith and presume there's no limitation on your powers. Okay, application. Let's apply the relevant rules to our story. So the article stated, directors may not, on behalf of the company, enter into a purchase agreement in excess of 100,000 without the approval of the members. So this is the internal regulation. It's saying that the board of directors, they usually have powers to enter a contract on behalf of the company. But the internal regulations is saying you can only do it for up to 100,000. For more than 100,000, you need to go to the shareholders in general meeting for approval. So you can understand for an outsider, they would not know this. Okay, so that's why if they're able to invoke 117, they are protected. So here, when the board signed the contract with BCL to purchase the coffee machine at 200,000 without informing May, that may amount to a breach of that article. Okay, breach of the internal regulation. Since Lily and Rahul held 400 and 300 shares respectively, it may be argued they may have approved the purchase as a member of SRL. Okay, so you realize as Lily and Rahul, they wear different hats. They are also shareholders. So is it possible to say they approve because they hold 70% of the shares? Nonetheless, even if it was a breach under section 1171, if BCL had dealt with SRL in good faith, it may regard the powers of the board to bind SRL in contract to be free of any limitation. So section 1171 is there to protect the outsider. And since there's nothing to the contrary that has been shown, you can presume BCL acted in good faith and not required to make more inquiries as to limitation of the board's power. Okay, so we have gone through a lot in today's workshop. You can see we have gone through a lot of the different topics under the 5 learning outcomes. We have selected some examples from short question and past exam paper to illustrate to you how different topics might be examined. We'll also discuss about the difference about your strategy, your exam technique of tackling section A questions as compared to section B question. And we've also looked at how you might tackle a Section B question, because they're longer questions, 25 marks. So how would you use the 45 minutes? So as I explained as a suggestion, that you will identify the relevant issues. Once you have done that, for each of the relevant issues, you will explain the relevant legal rules, maybe sections from an ordinance, maybe principle from court case, and then you will apply them to the story to arrive at your answer. So remember, in the examiner's comment, in addition to identify the right issues and using relevant rules, sometimes you want to do some analysis. Analysis discussing the content. In this case, the date of the contract is that date, the date of the incorporation that date. That's the reason why it's a pre-incorporation contract, and that's why subsection 1 will apply. So that will be an example of an analysis and application. Okay, so what to do in the next class? So of course, if you have not already done so, please revise your topic. That's very important. Most important is better to start early. That's always the recommendation. It's understandable. I've done it myself, having to study part-time. It's not easy. Okay, you have to manage your work responsibilities as well as spend time to prepare for exams. But we all have to do this. So what can you do? Start early. If you start early, little bit by little bit, each week, particular 1 day or 2 day or particular night of the week you work, then after 1 month or 2 months, you already have 100 or 200 hours already. Okay, it's much easier to start early. Do 20 hours a week or 30 hours a week, you'll find very easy. Also, if you start early and do 20 or 30 hours a week, some weeks something unexpected come up, maybe you cannot do your revision. It's understandable. Things come up at work or other matters, then at least you won't fall behind. Okay, you still keep up to date. So that's my suggestion, try to start early. Second, of course, review the questions covered in part 1. So you now have illustrative examples for you, so you can use those as a guide to look at them, look at how each question, how to identify relevant issues, how to identify which is the relevant topics, how to tackle the question. Most important, I think, very helpful is the examiner's comments, okay? Each of the past exam paper, there's always examiner's comment generally, but also on specific questions. So I think those can be helpful. But what I would say is do not just read many past exam questions and answers. Because when you look at a question, if you immediately look at the answer of a past exam paper, of course you'll find it easy. I know that. But in the actual exam, no one will give you the answer beforehand. You have to work it out yourself. So I think if you do want to practice past exam question, good, that's excellent. But try to do the question without looking at the answer. Okay, it's tempting, but please don't do that. At the very least, try to identify the main issue and then try to identify the relevant rules, and then you can check if you're on the right track or not. But for good practice, try to complete the question under exam condition, meaning limit your time. Okay, give yourself 45 minutes to try one of the questions in part B and see how you go. You need to do that for the actual exam anyway. So why not start practicing doing that? So when it's during the exam, you find it easier. Okay, that was my suggestion. But I would not suggest to try to do every past exam paper. Okay, that's not my suggestion. The reason is because my understanding is usually when someone sets a new exam paper, they would want the question to be different to the past exam paper. Okay, otherwise it won't be challenging. So my suggestion is do not just rote learn past exam question and answers. It's more important to go through the study materials, understand the different topics, so that if a question comes up on a topic, even if it was not examined before, you already have an idea. So you can attempt that question. If it's short question in part A, answer what you know. You already have 4 marks, 3 marks, 4 marks, or 5 marks. Very good, move on. Okay, if it comes up in part B, a 45-mark question, that topic may only be part of the question. So you don't need to worry, it may not be 25 marks, may only cover 10 marks of the 25 marks, who knows? So that's why do not panic. If you see a part B question, if that topic you did not cover in your revision, read the question carefully, read the story carefully. It is possible there may be more than one issue at hand. If the other issues you're familiar with, answer those part of the question. It is okay. But really try to draft your answer. As in try to write an answer. Maybe use the method I introduced to you here for practice. because once you're used to using the method, in the exam you can do it very fast. You will even find it will save you time because you will not need to write more. Issue, rules, application, conclusion, finish. Move on to the next question. Sometimes I see some candidates, they write and write and write, sometimes even repeating themselves because they're not sure how much to write. It's 25 marks, I better write more. And they end up repeating themselves and they end up using up their valuable time. But if they have a good structured way to answer the question, once they've completed the structure, they move on. They don't need to write more and they can be confident and then they can use the remaining time to answer other questions. And there's a good chance they will be able to attempt all questions, all part of the questions, and the chance of getting overall pass, of course, will be higher. Okay, so definitely try to practice before next time. Okay, so next time I'll be going through past exam paper questions with you to illustrate the different ways to tackle the questions. So we'll be focusing on section B question, the longer question, each one of 25 marks. Hopefully you'll find this workshop helpful and I will look forward to seeing you in the next workshop. Thank you.